Good morning, everyone, and welcome to the 10th ECB Annual Research Conference, which this year is jointly organized with Stanford's Hoover Institution. It's a pleasure to see so many distinguished researchers, colleagues, and guests gathered here today. The conference is somewhat provocatively titled "The Next Financial Crisis?" And to officially open our conference and deliver the welcoming remarks, it is my honor to introduce the President of the European Central Bank, who herself has extensive experience in managing financial crises. Please join me in welcoming President Lagarde to the podium.
Researchers, professors, policymakers, and students, and my colleagues from the Executive Board. Thank you for being with us. So it's a great pleasure to introduce and open the ECB Annual Research Conference. I think it's a flagship event by now, which brings together researchers from academia and policymakers so that in a spirit of good and respectful cooperation, we can actually confront ideas and compare notes and come to conclusions. And I found, I have to say, the title of this conference a little bit intriguing. Quite provocative, as you said, Luc, rightly, and I wondered whether I should really open the conference. Because my professional life in public service is just littered with crisis, one after the other, to the point that my husband actually said that I should not take another job after this one, risk of provoking yet another crisis. So being where I am and comfortably facing adversity, we still ask ourselves, with a big question mark at the end, please note, the next financial crisis. And the question mark is intended to express that we're not trying to trigger, to provoke, but to actually do everything we can to anticipate, prevent, and examine what the circumstances are that would actually trigger such a crisis. And I think we must keep 2 points in mind when thinking about the topic. First, throughout the post-war era, the global financial system has been in constant transformation, and the pace has only accelerated with advances in technology. And second, what appears new often simply reflects old risks, except with a different costume and in a different form. And here I'm reminded of Professor Carmen Reina and Kenneth Rogoff's and their history of financial crisis. This time is different. The book's subtitle, tellingly, is, not it's different, it says 8 centuries of financial folly. After 8 centuries of experience, I think it's fair to say that this time it is never different. And that is why research plays such an important role in helping to safeguard financial stability. Through rigorous analysis and a solid understanding of the past, research helps us see how innovation advances and reshapes the economy, while also bringing potential risk into sharper focus so that policymakers can address them proactively and hopefully anticipate them and prevent them. Research is particularly vital in helping us to understand the implications of the profound transformations that have reshaped the financial system since the global financial crisis, which is a relatively short span of time if you look at the 8 centuries on the one hand and the 15 years or so on the other hand. And one of the major structural shifts in the financial system over those past 2 decades has been the growing footprint, not so much of banks, but of non-banks financial institutions. We used to call them the shadow banking system. Now it's the NBFI, and all of you know what the NBFIs are. But they are non-bank, but yet financial institutions. And that will be the focus of today's first session. In the euro area, non-banks, ranging from investment funds and insurance corporations to money market funds and securitization vehicles and what have you, those non-banks have expanded from 140% of GDP in 1999 to nearly 400% of GDP today. 400% of GDP today. On a per capita basis, this is way more than the US market. So they play an increasingly important role in financing the real economy and in managing the savings of households and firms. They now account for over 60% of the euro area financial sector. The banking sector, which is the focus of your second session, is also operating in a fast-changing landscape, driven both by technological innovation and by the emergence of non-banks. For starters, technology challenges banks' business models through the rise of fintechs, as well as new innovations like stablecoins, if they gain substantial traction, and could cause a major threat, at least in this part of the world. On top of this, technology also amplifies both the speed and scale at which these risks can materialize. You would all remember March 2023, when 3 banks, relatively small, granted, but 3 banks nonetheless, collapsed in less than 5 days. It highlighted how social media can act as a powerful conduit and amplifier for panic and contagion, all the more so now that banking services are available on our phones. The bank and non-bank sectors are not just changing rapidly, they're also highly interconnected. In the euro area, for example, banks' asset exposures to non-banks are considerable and on average account for around 10% of significant institutions' total assets. Given this transformation in the financial system, astute supervision and regulation, the focus of your third session taking place tomorrow at the conference, remain, in our view, critical. Guided by the insight of cutting-edge research, it is incumbent on policymakers to remain alert to financial stability risks as what they are and when they emerge. These risks may present themselves in new costumes, arise in industries well-versed in obscure terminology, and be cloaked in the language of innovation. But in substance, the underlying types of risks are often the usual suspects. Non-banks face liquidity and leverage risks, banks face maturity transformation and run risk, and stablecoin issuers face redemption and reserve risks. But at the end of the day, it's always the same who hold the bag and suffer the loss. Europe is sometimes accused of over-regulating, but the role of supervision and regulation is not to hold back innovation or structural transformation. Far from it. On the contrary, it is to contain the risks that may accompany those changes. This helps to ensure that innovation can take secure root and actually thrive. With this in mind, Europe is now implementing an ambitious simplification agenda under the direction of the European Commission, and the European Central Bank will contribute with all the points that I have just made in mind. Because simplification does not mean deregulation, not here. It means maintaining resilience with a more effective and efficient supervisory and regulatory framework. And the discussions over the next 2 days will add insights to the debate on the efficient design of supervision. But before those sessions begin, the conference opens with a much anxiously anticipated keynote by my friend Raghuram Rajan. Thank you very much for joining us. Your experience combines a distinguished academic career. You started. It brings into your profile public service on the international scene as chief economist of the IMF, and I salute here one of your eminent successors, Pierre Olivier, who is with us as well, and then a very eminent role in domestic public policy as central bank governor of your country, India. Your keynote will reflect on the relationship between monetary policy and financial stability. And we're very grateful that you've accepted this task. We will not have all the answers on ensuring financial stability at the close of this conference, but testing ideas, comparing evidence, engaging in rigorous debate, we can make policy more robust in the face of an uncertain future. At a time of rapid transformation in the financial system, some may think the old risks no longer apply. But research and experience demonstrate otherwise. And as the French critic Jean-Baptiste Alphonse Carr observed, plus ça change, et plus c'est pareil. All right, I'll translate. The more it changes, the more of the same we get. So in other words, this time it's not different, but we have to be a bit different in the face of changes. Thank you very much. Raghu.
This is going to be a bit redundant, but all right. Good morning again, and welcome to the keynote session, which is titled Monetary Policy and Financial Stability. It's my great honor to introduce Dr. Raghuram Rajan, who is one of the most distinguished economists of our time. Dr. Rajan is professor of finance at the University of Chicago Booth School of Business, former chief economist at the IMF, and it was the 23rd governor of the Reserve Bank of India. He's renowned for his prescient warnings about financial instability well before the 2008 crisis, and his insights have shaped policy and scholarship around the world. He has also thought and cares deeply about the role of markets, social justice, and economic development. On a more personal note, I've had the privilege of working with Raghu both as a co-author and learning under him as my former boss. I have two bosses sitting here. I can say firsthand that his intellectual clarity and generosity as a mentor are as remarkable as his scholarship. And as if that were not enough, he's also one of the very, very few economists who can boast of having his own fan club on Facebook. It's a rare distinction in our profession. In any case, please join me in warmly welcoming Raghu to deliver today's keynote address.
Thank you very much. It's such a pleasure to be here. Actually, this is the first time I've been in this building, and it's such a fantastic building, certainly relative to the previous edition. Thank you, President Lagarde, and thank you, Luc. I couldn't have asked for a warmer introduction. So let me get straight to the talk. The problem with keynotes is you can't present your last paper. You have to be a little bigger than that. At the same time, this is a research conference, so I actually have to talk about research. And that combination makes it really hard. What I decided to do was really talk about research that's been building up over the last 20, 25 years. So some of it is dated, some of it is relatively new. But it's on this broader issue of monetary policy and financial stability. And let me jump quickly, since I have a lot to talk about and relatively little time. Central bankers in this room are very familiar with the Tinbergen rule. Essentially, you can't have more targets than you have instruments if you want to do a decent job. Put differently, if you've got a kid you've got to manage and you've got a dog you've got to manage, you've got to have at least two hands. At least two hands, because sometimes they're a little more complicated in managing. And take the example that most central banks have. They want low and stable inflation. We sort of think that's the way central banks can contribute to maximum employment. So the second target that many central banks have in mind is that they should also have financial stability. And the two are sort of interwoven, because if you have financial instability, you have a crisis, growth plummets, inflation plummets, and so on. So over the medium term, the two are coherent or consistent with each other. But if you do want to tackle these two, following Tinbergen, you need at least two instruments. And central bankers essentially tackle inflation with interest rate policy and financial stability with supervisory but also macroprudential policies, right? And so this has become a kind of article of faith. And the sense taken to an extreme is that these can be treated separately, that monetary policy and financial stability can be dealt separately with these two instruments. And in fact, some central banks even have separate monetary policy committees and separate financial stability committees. Sometimes there's common membership, but sometimes there isn't. One Scandinavian central banker used to complain to me that his financial stability committee did nothing to offset the effects of fairly accommodative monetary policy, and asset prices were going through the roof, but he could do nothing about it. So now, I want to sort of tackle this article of faith, and I'm sure nobody in this room sort of takes this as gospel truth, but in a sense, two instruments, you can have them, but that doesn't mean they're enough. One instrument can be really powerful, the other instrument can be really weak. And then sometimes they can be opposed to each other. And in that case, you really don't have two instruments. You may have one and a half or just one. And when you have one instrument and multiple targets, you have to ask the question, which target or which objective do I target this instrument towards? And that means trade-offs. And so what I'm going to argue in this talk is all the evidence we've seen over the last 20 years is telling us again and again there are trade-offs here. You cannot be pristine pure and set monetary policy according to the needs of activity and inflation. You also have to keep in mind, in a world where the financial sector is getting more and more sophisticated, about the consequences on financial stability. So that's where I'm going. I'm going to give you a few pieces of research here. Now, given the quality of this audience, there are so many papers I'm going to miss out in this very short talk. I can't accommodate all the wonderful papers that people here have written, so forgive me if I don't refer to your paper, but it's all embedded in the learning, collective learning that I'm going to talk about. So in this paper, Credit Bites Back, in 2013, by the way, there's been a huge amount of research post-global financial crisis, and that's been fantastic for the profession. What Joraf, Shularik, and Taylor examine is 154 business cycles in 14 countries. And they see that 35 of these coincide with the financial crisis. Now, the researchers amongst you immediately ask, what is a financial crisis? Well, there's a definition. Just take it as bad things happen. Bad things happen in a financial crisis. 35 of these business cycles coincide with a financial crisis. And they look at the effects of excess credit based on whether you had a financial crisis or not. And what is excess credit? Basically, they look back from the peak, look at GDP, credit to GDP growth leading into the peak of the business cycle, and essentially classify you based on how much that growth of credit is. And their finding is, first, financial crisis recessions are worse. That's no surprise. You lose a bunch of institutions, that's going to set you back some if those institutions had positive value. But more interesting is it's related to the credit intensity of the expansion. And this is the chart that I like in their paper. Basically, what you have in the top dark line is a normal recession. And what you have in the bottom lines are financial crisis recessions. And what you can see immediately is the normal recession, basically the recovery is pretty fast. So what's the y-axis? GDP growth. X-axis is time from the peak. So yes, you have a downturn with a normal recession, but the recovery is fast. With a financial crisis recession, the recovery takes much longer and is much slower based on how much credit growth was before. So credit growth is problematic if you happen to have a financial recession. Notice those fuzzy little lines on top. That is for different levels of credit growth in a normal recession. So financial crisis recessions are particularly bad if you've had the strong credit growth before the recession, okay? Then, of course, what this does say is, strong credit growth over-indebtedness is bad. Where does that over-indebtedness come from? A more recent paper, Accommodative Monetary Policy and Financial Stability, the tradition in these papers, many co-authors, so let me just talk about the first one, Grimm. This paper basically looks at monetary policy stance and defines that as the real rate that is in place minus the neutral real policy rate, right? So that's a measure. If that is negative, that means you're being more accommodative than warranted by what the equilibrium real rate might be, okay? And they take this averaged over a period of time, so they take the average stance, okay? And they look at the effects of the average monetary stance on a bunch of factors. So here, what you see, for example, is that when you look at financial crisis events, of course, this is a selected exposed sample of financial crisis events. If you look at the average stance before, it tends to have a U-shape. In other words, first there's a period of easy monetary policy. That's when, if you look at the left-hand chart, the credit to GDP starts building up. And then there's a period of tightening when, in fact, you're creating the conditions for a crisis, because at this point you have got an economy which is leveraging more and more, and you take out the oxygen, and then it falls deeply and sharply, okay? So this U-shape is a feature of these financial crises. They do it in deviations from the real neutral rate, okay? Jose Luis Pedro with Jimenez, Kushinov, and Richter do it with nominal rates. And they find the same pattern. So here, there's a lot of adjustment that goes on. You wonder, what am I missing here? Because they have to determine what the real neutral rate is, which is itself a huge exercise, look at the difference, average it, et cetera. But Pedro and his co-authors, Jose Luis Pedro and his co-authors, basically do it with nominal rates and see the same pattern. There's a period of easing when the credit builds up, and then a period where you say, things are getting out of hand, you start tightening, and that's when the roof collapses, okay? So this is something they look at, and what they do then is ask, some economic questions, such as, if I reduce the stance by 1 percentage point, that is, there's an accommodative stance and make it even more accommodative by 1 percentage point, what does it do to the probability of crisis? And the answer is, in the short term, reduces it. Not particularly surprising, more accommodative policy short term reduces the probability of crisis. Longer term, and that's the y-axis is the increase in the probability of crisis, the x-axis is the horizon, time horizon. In the longer horizon, it increases the probability of crisis. And similarly, they ask question, what if I reduce the stance by 20%? And you get the same answer, but higher probabilities of a crisis if my stance is in the lowest 20%. Now, you might say the stance of monetary policy is endogenous. It depends on the environment, et cetera, et cetera. So how can we be sure this is something real going on? Well, what they then point out is the natural experiment. Many people have pointed out that in the Eurozone, you have one policy rate, but you have many different countries, all of which have different real neutral rates and have different rates of inflation, right? And so what you see is when you measure the stance of policy in the different Eurozone countries, you see before the global financial crisis, something that many in this room already know, there were very different stances of monetary policy depending on whether you were in the periphery or whether you were in the core. In the core, with lower inflation, the stance was pretty much close to neutral. In the periphery, with much higher levels of inflation, but also probably the real neutral rate was higher than what it was in the core, the stance was very, very accommodative. And if you look at every measure of activity as well as finance, a big difference between the periphery and the core? We know because the periphery eventually fell into crisis. If you look at, for example, total credit, much higher in the periphery, the credit growth, especially from 2003, in the core, not so much. Look at business credit, mortgage credit, even house prices, bigger ramp up in the periphery rather than the core. The only place where you see no difference is really in stock prices. I'm not sure I have an explanation for that. But on credit, you see much bigger changes in the periphery. One last piece of evidence here is Mexico is very interesting because Mexico has many foreign-owned banks, okay? And a big chunk of the domestic banking sector is owned by foreign parents. And so what this paper looks at, Moraes et al. In the Journal of Finance 2018, is they look at what happens when you have an easing in monetary policy in the parent country of the subsidiary in Mexico. And that's not driven by Mexican monetary policy. It's driven by the parent country, right? And they do all the usual corrections that you can think of, Kwajalein, et cetera. And they basically find one standard deviation reduction in foreign monetary policy rates leads to an increase in the credit volume by the corresponding foreign bank. So if you are Santander, what happens in Europe matters for your subsidiary in Mexico. Credit volume goes up, loan maturities go up. That's a measure of credit risk in a sense, if you're taking greater loan maturities on your lending. But it increases the probability of future delinquencies by 9.8%. And this is correcting for everything else. So this, I think, is very persuasive that monetary policy affects credit, but not just in a positive way, we know that, but also in a negative way. That's the increase in delinquencies that we're talking about. So there is an increase in risk-taking in response to the easing of monetary conditions or QE in the home country. Now, of course, this leads to a question, why do low rates precipitate risk-taking? And there's a huge literature on this. Let me just refer to some of the papers. Of course, the ones I know best are the ones I wrote, so I'm going to talk a little more about them. But very quickly, my colleague, Yuran Ma, along with Lian and Wang, has a very nice paper which does experiments and shows that people, when they offer two different portfolios of assets to invest in, display a behavior of more risk-taking when the policy rate or the risk-free rate is lower. And they attribute it to two explanations. One is if you've been in a period of very high interest rates, and then interest rates come down a lot, even if the reason is inflation has come down, and I'm talking about nominal interest rates here, you basically are at that point saying, I'm not getting anything, neglecting the fact that inflation is also lower. And so you search for yield. You take greater risk, right? That's a behavior they find, and they call it reference point. My reference point was high interest rates. I now have low interest rates. I take greater risk because, when it was 5 and now it's 1, I don't like it, okay? The second is salience. Think of the risk premium as being about 5%, okay, on risky assets. If the risk-free rate is 5%, that means the required rate of return on these risky assets is 10%, okay? Now, let's say the risk-free rate comes down from 5 to 1. What happens to the rate on risky asset? It comes down from 10 to 6. Between 5 and 10, I'm happy putting a lot in 5 because that's still quite substantial. Between 1 and 6, 1 gives me nothing. 6 gives me 5% more. And it looks a lot better. And that's what they call the salience effect. It looks much better. And so they attribute this risk shifting to that. But there are other reasons people have come across. One is the search for yield to cover fixed savings. When you have pensioners, largely invested in fixed income. When real rates go down, when nominal rates go down, they basically want a boost because, if they don't make a higher rate of return, given their fixed outgoes pending when they retire, they're toast. So might as well take a little bit of risk, and they have a better pension. That's sort of a received wisdom, which I think a bunch of people have written about, but that's another reason. And of course, a similar reason is in financial intermediaries. When you have fixed claims, you're an insurance company, you have fixed liabilities, and rates are really low, you got to find some additional way to make returns, and so you tend to search for yield to cover these fixed liabilities. I will talk to you in just a moment about the bond basis trade in the US, which is precisely that. A huge trade, which is basically a search for yield by the pension funds and the insurance companies, and it's flourishing even as we speak. This is something I talked about. Drexler, Savoy, and Schnabel have a very nice view of this. That is, it's based on your branch network. If you have a branch network, it has fixed costs. As interest rates come down, you can't cover the fixed costs of the branch network. You take more risk, and that's one reason. Another point sometimes is really, you've got, especially in periods of relatively low interest rates, Drexler, Savoy, and Schnabel talk about the fact that a bunch of banks don't, actually, let me put it this way. When interest rates are going up, a bunch of banks don't pass through the higher interest rates to their depositors. So a bunch of depositors leave. Where do they go? They typically go to the more competitive banks. That's what we found in this paper with Granha and Lloyds. And what do the banks that receive this money do with it? They don't put it in safe securities, they lend it. And when you're in a competitive area and the lending is already pretty competitive, you make a lot of mistakes. And you can see that in the data. Inflows have a bad effect. We saw that in the 1980s also, when the big banks were recycling petrodollars. A huge amount of money was coming into these banks, and they didn't know what to do with it. Instead of sitting tight on it and putting it in US Treasuries, they put it in riskier instruments, and we know the crises that happened in the 1980s. I think this is a pretty strong phenomenon in financial intermediaries, the inability to deal with large inflows, which are sudden. And finally, this herd behavior. Jeremy Stein has a very nice version of this, but this is a standard feature among bankers. They're making money. I'm not. Maybe I should ramp up my risk in order to try and meet the kinds of returns other people are doing. Fear of missing out, big factor during the run-up to the global financial crisis. But let's move a little from this notion. Yes, there is a lot of evidence. Monetary policy connects to financial intermediary behavior, connects to credit growth, connects to bad stuff happening. A long period of very accommodative monetary stance builds up the problems for the future. That's what the literature seems to suggest. Well, we also seem to have invented a new instrument in the last couple of decades, which is liquidity. Not so much the old version of liquidity, come in quickly, infuse liquidity to liquefy the system. That was the natural role of central banks. That was why the Fed was created in 1913, to liquefy the system when it ran out of liquidity. But we're talking about a different form, which is more permanent, longer-term liquidity. And one example of that is quantitative easing. Let's pump the system with liquidity and give it a sense that that liquidity will be around for a long time. Can this serve as a monetary policy tool? Can it serve as a financial stability tool? It was first utilized in the US in 2008 more as a financial stability tool to repair the mortgage markets. But then, without too much dialogue, it morphed into a monetary policy tool. In a period of low interest rates, we are going to keep a lot of liquidity out there in an attempt to push long rates down. Okay? You all know how QE works. The central bank buys buys long-term instruments from the market, takes out duration, and substitutes it with short-term reserves in the balance sheets of the banks. And the argument is, one, this should make the market hungry for duration, should bring down long yields. But two, because the banks are so full of liquid assets, the most liquid asset on the planet, which is short-term reserves, it should basically make them much more favorable to supporting liquidity needs, et cetera. The whole system should be much more liquid. Well, it turns out that after the huge infusion of quantitative easing and then some retrenchment in quantitative tightening, the system started backing up in the US way before you went back to the old levels. Earlier, the amount of central bank reserves were some fraction of 100 billion, maybe 50 billion or 80 billion. After quantitative easing, it went to 1.5 trillion. But you pull back a little from that. This is the first rounds of quantitative easing I'm talking about before the pandemic. You pull back from that, September 2019, the system seizes up. You have the repo calypse, in a sense, repo rates going through the roof. And it's happened again and again, March 2020, March 2023, April 2025. And each time you have huge amounts of reserves out there in the system, but the system is backing up. Why is that happening? Why is the system backing up despite all this liquidity out there? And again, I think the argument is this is not a free instrument, and it has consequences which then make it much less effective. So this is where Viral Acharya and I have spent a fair amount of time along with co-authors. Essentially, liquidity is like a drug. It induces dependence. I use the drug, and I want it to, the supply to continue. If the supply gets withdrawn, I have withdrawal symptoms. That's the problem. Let me try and explain it in more sort of scientific terms. Essentially, liquid central bank reserves don't pay very much. There's a lot of liquidity. There's a liquidity embedded in them, which is why they don't pay very much. So why don't I use the liquidity if I'm a bank? I have the asset sitting on my balance sheet. I need to use it in some way. How do I use it? Well, think of 3 ways that we document in this paper on how banks used it as quantitative easing happened. They issue cheap uninsured demand deposits, basically wholesale deposits. That's a claim on liquidity because they can be withdrawn at any time. You need the liquid assets to support those uninsured demand deposits. But those uninsured demand deposits are cheap, and that's a good thing, okay? The second aspect is, I don't want costly time deposits. Time deposits buy me time, but I don't need them because I pay more for them. If I've got all this liquid assets sitting, I don't need the protection of time deposits. So I run down my time deposits at this time. I also write lines of credit to anybody who needs liquidity. So my lines of credit writing go up, and they're available. That liquidity is available for anybody who wants it. And finally, I start funding levered speculation of different kinds. And there's a paper on the program that you'll see tomorrow on real estate and the effects of QE. But I think what we see is it has a lot of unintended consequences. Again, Jose Luis Pedro just sent me a paper last night on the effects of QE. But all these are, I think, longer-term effects from something which we thought would be very benign, but is not so benign. Each of these actions by the banks is a claim on liquidity which eats up the central bank liquidity that has been put on the bank balance sheet. Net effect, you are much more dependent on the liquidity than you were before. When that liquidity is withdrawn, you find the system backing up much earlier. It doesn't wait because it's already been promised away in different ways. So in other words, liquidity supply, you supply a lot of liquidity, demand also goes up. And you're not in the old place again. Let me give you one example of this, which is based on a paper by Kashyap, Stein, Wallen, and Younger. How low interest rates and liquidity demands sort of fuse together. And this is in what is called the bond basis trade, okay? So here's what happens. You have insurance companies and pension funds that don't like the low yield environment. They want higher yield. So what do? They buy corporate bonds, which have a risk premium, a credit risk premium, in addition to the risk-free rate. That gives them more yield. But of course, corporate bonds are not that long duration as treasuries. These guys need much longer duration. And so what they do is they buy corporate bonds, and then in the futures market, they take a positive exposure to long-term treasuries. So they get the duration from there. But for that, they need to buy futures. Who's going to sell them the futures? Basically, hedge funds sell them the futures. And hedge funds selling the futures are short treasury futures. They have to be long something. They buy treasury bonds. How do they finance the treasury bonds? Through an enormous quantity of leverage, repo transactions in the financial markets. So this is what is called the bond basis trade. The hedge funds make a tiny spread on each such transaction, but they do a lot of them based on limited liquidity, and so they have huge profits from this, steady profits. It's steady until it blows up. And it blows up periodically because of exogenous events, a pandemic, or just the US Treasury demanding more for its Treasury account. Liquidity conditions are very important to this trade. Every time it blows up, Treasury yields spill out. The Fed says, oh, the markets are broken. We have to come to the rescue. They come, rescue, and the hedge funds are back to it. Now, the hedge funds, when you talk about disrupting this trade and saying there's a problem, say, no, we are funding the US government because we are buying treasuries in such a big way. How will you fund it? But the real problem is not so much funding the US government, but the search for yield by the pension funds and the insurance companies. That is, they're trying to get that extra yield, and in that process, they're creating enormous risk within the system because of the high leverage. And that's something to keep in mind in this kind of, that the intervention in itself sort of makes the trade much less risky. And as a result, you get more of it. So one is the liquidity issue. Liquidity creates its own demand. The other is the intervention issue, which exacerbates that demand. And let me come to that as the last point, which is, central banks can't stay and see collapse. There's no way they're going to see and watch it happen. So they're going to intervene, right? In fact, central banks were created for that purpose, not for monetary. Let me take that back. The Fed was created for that purpose, not for monetary stability alone. It was created for financial stability after the Knickerbocker crisis in 1907. And so central bank intervention can eliminate this illiquidity, fire sales, and bank runs to a large extent. And so one way the Fed could react to this is saying we can't recognize or prevent asset price booms or credit booms. We can mitigate the fallout when it happens. And Greenspan, this became the Greenspan doctrine, or in less charitable ways, the Greenspan put, that the central bank was offering a put. It would reduce interest rates when bad stuff happened. It would create special facilities, 2023, that President Lagarde talked about. Bad stuff happened. You bought assets from the banks at non-market prices in order to bail them out. That's the special facility. Liquidity, of course, we've seen it infused again and again. I'm not saying these are wrong, but once the market relies on it, it becomes a source of significant moral hazard. You can't avoid it, but it becomes a source of moral hazard. And so it undermines everything, including the disciplinary role of deposit contracts. Walter Bagehot had this rule to avoid moral hazard. There are arguments about why he exactly enunciated that rule. Was it to save on gold, or was it to avoid moral hazard? But his point was lend freely against good collateral at a high rate, right? That is the theory. That is how you avoid moral hazard. The problem, however, is it's very hard to charge that high rate in the middle of a crisis. It is very, very hard. And so, as the Fed did, you charge actually a low rate, in fact, a negative rate in lending to banks in bailing out. And President Lagarde talked about the 3 banks. Actually, in nominal terms, the failure cost was perhaps one of the highest in history. But importantly, 22 other banks were being run at that time. This is the biggest non-public financial crisis in a way, it was resolved because of intervention. But it was a huge accident we don't talk about anymore. And what is important is the Barr Committee report which went into it. In its terms of reference, monetary policy doesn't show up at all. There's nothing about could monetary policy have contributed to the risk-taking that Silicon Valley Bank, for example, indulged in. It was all supervisory, management, et cetera. Terms of reference, nothing about monetary policy. This is why I think we do need to look at this carefully again. What about charging the budget rate? Well, it turns out, what is the budget rate? In simple models, it turns out the budget rate is actually the rate the private sector would charge. That's what gets you back to no moral hazard. Impossible to charge that rate for the public sector to charge that rate in the time of crisis. You look like a usurer at that point. So you can't charge it ex post. That's reflected in the Fed facility in 2023. What about ex ante? Mervyn King has this wonderful idea about offering insurance facilities to the banks, pre-committed facilities, pre-positioned collateral, pay for it, et cetera. The problem with that, however, is if you charge the right rate, you will see the premiums build up very quickly. Because no accidents happen, premium build up, like premium build up in deposit insurance funds, and the banks start saying, what nonsense, why are you charging this high rate? And you pay down the premium, and it turns out the eventual sort of crisis is much more costly, and the premium were never enough for what happened. So what I'm broadly saying is the costs of public insurance. It's very hard for the public insurer to charge the appropriate rate, and that creates problems in public insurance. I'm getting to the end, and I will finish very quickly. So central bank intervention turbocharges the incentive effects of accommodative policy. And there's this very nice paper by Neil Ferguson and others in 2023, which basically tries to look at the really long run, 87 to 2020, and looks at central bank intervention and tries to see what the consequences are. I'm not sure which central bank was there in 1587, but I think the Bank of Sweden says they celebrated their centenary. That was Nobel Prize being set up, right? So that's, anyway, whatever that central bank is. Basically, they find, and I'm summarizing a very, very long and in detailed paper, that liquidity support during the financial crisis certainly helps. It ensures crises are less severe, but raises the probability of future boom-bust episodes. So, bottom line, to conclude, does the separation principle hold? Probably not, okay? Using prudential measures alone, and this is sort of another way of saying what Jeremy Stein said, the point about monetary policy is it gets into all the cracks. If you don't use monetary policy, prudential measures alone leave that large non-bank system out of the spectrum and largely focus on the banking system, and not very, very effective sometimes in the midst of a frenzy. It's like waving outside the window, believing the air friction will slow your car down even while you're jamming on the accelerator, and the accelerator is monetary policy. So this leads to asymmetric monetary policy if you firmly believe in the separation principle, which I would argue, hopefully most central bankers don't. Because in normal times, you work focused on monetary policy to get activity up, and you say the supervisor will take care of it. But then you see the times of stress. At that point, you become the only game in town. You have to intervene. You have no other choice. And it becomes very asymmetric. Normal times, nothing. Bad times, massive intervention. And you get boom to bust to boom again. And I think this is a problem, because at some point, central banks are not going to be credible with their enormous resources, because the backing for them is the government. And across the developed world, we have governments with limited resources now. And so central banks are not going to be as, the Bank of Zimbabwe has very little credibility when it comes to intervene in a big way because its government doesn't have that many resources. It's that combination which is effective. And so while supervisory and macroprudential tools should be the first line of defense, I'm not disputing that at all. And we should get more creative and innovative on those in a sensible way, they're likely to be insufficient. And so in a sense, I'm echoing work that started with a fantastic paper by Claudia Borio and Philip Lowe in 2002, which has set the grounds for all this research, that if you look at a combination of credit growth and asset price growth, you're looking at flashing red lights, that this is danger, and the monetary authorities, supervisory authorities should intervene. So bottom line, let me end with this. Use macroprudential to the fullest extent. In crises, intervene using all the tools you can, but be very careful about time limiting that intervention, including on monetary policy. Don't keep monetary policy setting at crisis levels forever in an attempt to revive activity. It may be the wrong tool to revive activity at that point. And certainly in normal times, keep an eye on financial stability. And if your monetary policy is attempting to revive activity, but seeing the financial sector move faster, be willing to raise policy rates to normalize them faster than otherwise warranted. And always be explicit about which objective you're targeting. Is it inflation, or is it financial stability? And I think the LDI intervention by the Bank of England was a very good example of being very precise, very focused in an attempt to revive market conditions. And that's something we all can learn from. Let me stop there. That's what I have.
Well, thank you, Raghu, for this interesting setup. I'm afraid we're going to not stop you there and open the floor for questions. So if you have questions for Raghu, then please wait for the mic, stand up, mention your name and affiliation, and keep it short. We have plenty of time, but I do want to make sure everyone has an opportunity. So I see Isabel, you would like to start, and then Pierre-Olivier. Could I have a mic up front here?
So thank you very much, Raghu, for this fantastic presentation. I have a lot of sympathy for basically all of the things that you've said. And as you may know, in our previous strategy review, not this one, we talked a lot about financial stability. We also agreed that we have to take financial stability into account in our monetary policy. I mean, in practice, it's hard to do. Because what I learned over the time is that, if there's a financial stability threat tomorrow, that's very convincing. And then, to have a looser monetary policy stance because there could be a financial stability risk tomorrow, that's very convincing. But to say, now we tighten monetary policy because there is a financial stability risk building up over the next 5 to 10 years, that is not very convincing. So there is this asymmetry because of the time horizon, which is very tricky for policymakers. So that's my first point. The second point is a question. So what does all of this imply for central banks' operational frameworks? So, there are kind of two different, stylized types of operational frameworks. There is a more like demand-driven framework as we have it. The Bank of England has it, and there the idea is that you actually want to get excess liquidity down, but at the same time you have your refinancing operations where you provide liquidity at fixed rate full allotment at a small spread typically, in order to also deal with this issue that you may have too much liquidity creation otherwise. And so you basically have this idea of providing more like exposed liquidity. And then the alternative would be the Fed system where you keep the balance sheet relatively large and you provide more liquidity ex ante. Do you have a view on that, how it relates to your presentation?
So great questions. First, I think in the same way as you try and anticipate inflation. And inflation may be, in the ideal world, central bankers looking ahead and looking at the possible sort of sources of inflation and adjusting monetary policy, keeping that in mind. Perhaps we should spend more time thinking about sources of financial instability, asset price growth, for example, real estate price growth, credit growth, and project out over a period. This is what it looks like. And of course, it's going to be initially very, very uncertain, just as inflation projections always turn out to be somewhat incorrect with wide bands of error and so on. But it would be a way of bringing this into the calculation. At the very least, bringing the discussion into the calculation. Here is what this looks like over time. Let me tell you what I worry about. Today, if you look at the Fed's situation, it's really about inflation versus growth, right? If you look at the last 4 months, inflation is going up, growth is going down, and this is should I choose this or this? What is left in the background is the enormous sort of, let's say, exuberance in the financial sector, whether it be credit or whether it be, and I'm not saying that this is necessarily going to, collapse tomorrow, but these are conditions which become very reliant on a continuation of benign overall conditions. And when those turn, whether it be because AI suddenly people lose faith in and all the credit that's going into AI, all the investment that's going into AI facilities starts looking a lot peakier than earlier. We don't know. But there is no talk in the Fed about this factor, or the fact that ever since the Fed started raising interest rates, financial conditions have been really quite benign. They haven't tightened. Yes, nobody's getting mortgages at 7%, that's fine. But everything else is really chirping along, including corporate credit. So, and private credit, of course, is going through the roof. So what I'm saying is we need to keep an eye on all this. The second question was on temporary liquidity versus permanent liquidity. I'm much more a fan of temporary liquidity. But you don't want to make the system illiquid. But you don't want to encourage reliance on central bank provided liquidity for a long time. So I would be more in favor of the Fed trying to reduce its balance sheet over time, but that's proving very hard. Every time it reduces it, then signs start propping up that the system is getting illiquid. And that's the ratchet effect. And I don't know what the answer to that is.
Good. Pierre-Olivier?
Pierre-Olivier Gouacha from the IMF. So my first question is actually on your last point, on the ratchet effect. So if we look at the US balance sheet, it was about, at the peak, it was about 9 trillion in 2022. It's down to 6.5 now, so there's been a significant amount of QT. Now, 6.5 is still much higher than where we were pre-COVID, around 4 trillion in September of 2019. But if I scale it by nominal GDP, which has increased a lot also during that time, it's about the same. It was 18% in 2019, it's about 20% now. So we're back in terms of the size of the balance sheet to where we were pre-COVID in the US. So is there really a ratchet effect in terms of the huge increase in the size of the balance sheet through the COVID episode? We've had QT going on for a while now, and we're back to pre-COVID. So that's the first question. The second, on the separation principle, I wonder if we should separate what happens when the central bank wants to ease versus when the central bank wants to tighten. I mean, when you mentioned SVB and the other banks that were under stress in 2023, this was in an episode of tightening of monetary policy, not one in which central banks were easing. Now, I could see when central banks are tightening and financial institutions have long-dated assets and are going to be hit on the valuation side, that could create trouble in the financial system. That's exactly what we saw. It's a little bit harder for me to see necessarily how, when you're easing, how you could, not deal with trouble in the financial system, because that's a time when you can easily increase liquidity. There's no tension with your price stability objective in a sense. So there are times in which your price stability objective and your financial stability objective are aligned, and there are times when not aligned, and I think inflationary environments is when they're not aligned. So I'm curious if you share that view. And the last thing I wanted to ask is, you mentioned the exuberance in the U.S. Financial markets, and I think one driver behind this is, of course, all the excitement about the AI boom. Now, one might think that this situation has a number of similarities with the dot-com boom of the late 90s, which is a time when the Greenspan doctrine was articulated. And so if I hear you, you're basically saying the Fed right now should be much more in a tightening mode because there is a risk that we could get financial instability down the road. That doesn't seem to be where the current conversation is going. I'm just curious to hear from you.
So let me go backwards. Yes, there is no conversation about the financial sector and the exuberance there. And I'm not necessarily saying that there should be tightening. I just imply much more supervisory, regulatory, and to some extent, monetary policy attention to that. I mean, it's not, why is there such strong demand today in the US, despite the slowing in the labor market? Some of it is wealth effects from this financial exuberance also. So it's not irrelevant to the monetary policy discussion. And I would say that, bringing that into the discussion may give you a different answer from we should cut rates significantly now so as to rescue the economy from the downturn. So that's, I think I would like more of a conversation rather than saying this is a time to raise rates, but bring that into the discussion. The second is, look at those U-shapes, right? Those U-shapes seem to be saying that the seeds of the crisis are set in the good times. And then as you sort of recognize that and start tightening, it's usually too late, and then you bring the house down. So, I mean, there is a hugely complicated optimization problem for central banks, right? How do I prevent that easing and the exuberance at a time when nobody's paying attention to it, and it's politically very difficult. And of course, politics around central banks is something we all talk about nowadays, right? So how do you convince the public that it is time for me to normalize and not go further? Because if I normalize later, I will precipitate the very crisis that I'm trying to avoid, right? 2006 was not the time for the Fed to normalize because, things had already gotten way out of sync. So it does imply sort of being much more forward-looking in these ways. And do we have the tools for it? Not yet. But if we don't pay attention to it, I mean, the worry I have is we've had two massive crises. Governments have very little money. One more crisis, and we're kaput as a system, right? Central banks will not have the power if the governments don't have the power. To the first point, it's always nice to pick the reference point where you want, right? The Fed balance sheet in 2008 was 800 billion. So 4 trillion is 5 times that. GDP hasn't grown that much, right? So, I mean, look, I agree with you that this phase of quantitative tightening, how much, LDI and how much Silicon Valley Bank were related to that, let me leave aside, but has been relatively okay. The Fed did cut back on the QT, but it also, for the most part, created a whole bunch of new facilities, which pushed reserves back to the banks and withdrew reserves from the non-banks. So a lot of the tightening in the first phase was from the money markets, right? The reverse repo. Now that's died, that's ended, and they're cutting into bank reserves, it could get tighter. But it may well be that a slow period of quantitative tightening is the way to go. Well advertised slow, that the banks know that this is coming. But you do need, in my view, to reduce the reliance on cheap central bank liquidity.
Good. We have a debate ongoing. That's exactly what we want. Okay, then I have Emil next on the other side.
Hi. Thanks a lot, Raghu. That was fantastic. So Emil Werner from MIT. I wanted to just probe you a little bit more on that extremely complicated intertemporal optimization problem you said central banks had, because I was thinking about that as well. So you're describing this credit cycle that we have very good evidence for, that basically borrowing decisions today might be expansionary today, but in 3, 5, 7 years, they can lead to problems down the road. So in other words, there's sort of this very complicated state variable that the kind of financial conditions leave, that it's not just about financial conditions today, but the whole history of financial conditions. And when we think about optimal monetary policy, we sort of think, about the Taylor rule or sort of deviations from the Taylor rule. So I wanted to kind of get your views. There's sort of two perspectives from what you showed. One is the Grimm work sort of suggests that, if we can just see our star, which is of course very difficult, but if we can measure this better and not have these times where we go very far below our star, then maybe we're okay. But the other perspective is, well, maybe that's actually just impossible to do, and so maybe we should just sort of have less of these U-shapes. Maybe we should do less and normalize more quickly. So I wanted to get your perspective. You alluded to this very complicated problem, but I wanted, if you had more to say.
So we're backing off from the complicated problem. What is my sort of one-line philosophy, right? It's don't try and do too much as a central bank. That you really can't do all the things people want you to do. How do you sell that is a very different question. And that's really the question of our times, right? That on the one hand, I mean, just going back to the debate in the US, the administration is saying the central bank tried to do all these things and it shouldn't have tried to do all these things. But then through the back door, now there's a third objective which has been introduced, which is long-term interest rates. So, damned if you do and damned if you don't. But not saying the job of a central banker is easy. But I am saying that it is useful to keep sending the message there's only so much I can do without creating more problems. Sort of a Hippocratic oath in some sense that I have to avoid doing bad stuff. And so that limits what I can do even in normal times. Put differently, I would not try to keep rates at a level to urge economic activity when economic activity, there's so many other instruments which are not being used by the others. And I would say, maybe I should just try and normalize and let them use their instruments, put political pressure on them to use instruments. Again, central banks can't talk this way because they're not elected. But in a sense, what you want is the political authorities to not become overly reliant on the central banks to pull their, acorns out of the fire. Because I think the problem is when the central banks go that way, eventually they create problems for themselves to deal with down the line. I know Christine is probably thinking this, looks all very easy when you're sitting in academia. And I agree entirely. I'm not saying this is easy. All I'm saying is we should think much more about these things because I think the buffers we had in developed countries have dwindled. And you can't do another mistake of this kind in the next decade without massive political problems coming to the fore.
Okay, then the next two questions, let's take them together and please be brief. Enrico and then Rafa.
Thank you. Enrico Perotti, University of Amsterdam. Raghu, just trying to put in very simple terms this fantastic big picture. I think we have two tools and three goals. And the third goal is economic growth or economic prosperity. I mean, think of the analogy between credit booms where you create a lot of leverage, which is downward rigid, or wages, higher wages. We know it's the core of all models, instability. And then when reality hits, we have a trouble. And then equally, we go through a long period of prosperity in which we keep raising expectation of living standards. And it's no longer acceptable to face the fact that we cannot keep producing them. And in the end, the central bank is the only game in town. like your comment.
Agree entirely. All this implicit leverage, that's a brilliant point. Wages, expectations, those are forms of implicit leverage which make it very hard to readjust when things go sour. I'm not saying we should constantly be worried about the sky falling on our head and therefore never enjoy a period of growth. But it does mean that we have to be a little worried that these things don't get back, that there is a ratchet effect in everything.
Rafael Repullo from Sanfi Madrid, Spain. In thinking about macroprudential policies to deal with financial stability concerns, what weight should be given to countercyclical buffers vis-a-vis borrower-based measures?
Great question. I don't have an easy answer to that. I mean, you know that Spain had macroprudential policies before the global financial crisis, and there's some sort of research gone into that. How effective were those? And I think they were modestly effective, but clearly Spain had a crisis. And so, I think we've done a lot of work on macroprudential. We've done a lot about forward-looking measures, but I think the jury is still out till we have another crisis and see what happens with those. All I'm saying is don't be overly reliant that they will pull the bacon out, that they can be of limited value also when everything else is going south.
On that positive note,
No.
I'll let you off the hot seat now. We have coffee and we reconvene at 11:30.
Okay, welcome back. The first session that we are going to be talking about is about non-banks. And I'm very happy that we'll be starting with the paper, Where Do Banks End and NBFIs Begin, presented by Nicola Cettorelli from New York Fed. So Nicola, you have 20 minutes.
Thank you, Amit. And we are extremely honored that you decided to put this paper on the program. This is joint work with Viral Acharya and Bruce Tuckman, both from NYU Stern. It is FOMC Policy Week, so my disclaimer is longer than usual, but just as binding. So definitely these are just my own, my own views. Why don't I get started right away? When Viral, Bruce, and I started sharing thoughts and ideas 3-4 years ago about this, what is now actually kind of a research program, we have at least 3 papers already written on this topic. We were motivated by what actually President Lagarde alluded to in her opening remarks this morning, this magnificent growth of non-bank financial institutions that has been observed globally. Related to it, what seems to be at least somewhat of a replacement of non-bank financial intermediaries over traditional intermediaries, banking institutions. And so the research program that the 3 of us have put together is really revolving around this fundamental question. What is really going on in financial intermediation activity? Is it really that non-banks are intermediaries that are displacing banks? Are they actually becoming the dominant source of financial intermediation activity? And so as we were formulating our thoughts, we were confronted with what we consider the standard, the conventional, perhaps interpretation of this phenomenon. One is what we call the parallel view, which is that, okay, so we have banks on the one side, they are actually intermediaries, and then we have this evolving and ever-expanding set of other type of financial institutions, but truly what they do is something else. They are providing very important financial services to an economy, services for investment activity, risk management, trading, and so forth and so on, but they are not necessarily in the business of financial intermediation. So if that's the prevalent view, then if something goes wrong in that segment, we perhaps collectively have the luxury of let that go. No, there is not going to be much in terms of systemic implications. So maybe a possible policy stance is to keep perhaps these activities separate from banking institutions, and everything will be good. Now, in hindsight, not everything really is that good, because I think we have now repeated examples from recent history where, in fact, there has been the need to intervene in this broader, ever-expanding space. And so the more prevalent view is what we call the substitution view, where, in fact, you make the case that these financial institutions are intermediaries. They are, therefore, for whatever reason, maybe they do it better, maybe banks are more constrained, but they are effectively replacing banks as intermediaries. So what's the implication of that? That maybe if they are intermediaries, then they are, to an extent, potential vectors of systemic externalities, and so we should be treated the same way that we normally treat financial intermediaries, a prudential monitoring, prudential regulation, and this has inspired at least some sort of proposal on the table, as the one that I mentioned here in the bullet. Now, there is a little bit of a silver lining if you subscribe to this view, which is that, okay, at least banks are narrowing their scope. They are moving away from the riskiest activities, and maybe that's a good thing for the value of their deposit franchise, and ultimately it's a good thing for taxpayer, right? Because the taxpayer ultimately is on the hook in situation of crisis. We take exception to that point, and I will return on this in a few moments. Of course, we write papers because we want to propose something different, and so we converged on what we call a transformation view. And the question is, transformation of what? What is the transformation about? So I don't have that much time for this presentation, so this is I think my main slide in terms of takeaways. If there is a slide that I would like you to remember, is this one here. So bullet by bullet, this is sort of summarizing our viewpoint. The first point is that banks are not dying. They never die. They are incredibly resilient, and there are fundamental reasons why that is the case. And I will hopefully be convincing about it again in just a few minutes. And so what perhaps we are observing when we observe this growth of the NBFIs, that is actually the result of banks that are changing, transforming really their own business model, their own risk-taking. And so associated to that, much of that NBFI growth that we have been observing in the last 10, 15 years or so is actually there because banks support it. Right? There is really an issue of dependence behind it. And so the banks, much of that growth really requires bank support. And so the point, which I think is a deeper point than what this bullet point perhaps suggests, is that you cannot really look at NBFIs and banks as two separate things. Right? In a way, we may have clear ideas about organizational boundaries, right? There are these institutions that are, yes, organizationally separate from banking institutions, but in terms of operational boundaries, that boundary is probably much more tenuous, and that's really where our analysis hopefully comes into place. There are implications of that. And the implication is that perhaps there are systemic implications associated with this transformation. It's not as simple as perhaps NBFIs up, banks down, and risks migrating outside of the banking system. In fact, there is a potential for an underestimation of banks' true risk exposures. And as a system, we suggest that, in fact, the propagation and amplification mechanism may have become less clear and also, in terms of scale, larger than what the system was before. Okay, so that's, again, in terms of takeaways. So let me spend 2-3 minutes with really basic points about what justifies our transformation view. There are just two basic elements. The first one is the observation that bank regulation became much tighter post-financial crisis. So banks have indeed been subject to much higher regulatory constraints in terms of engaging in the riskiest activities, and also the requirement to hold larger liquid buffers. So that in and of itself would explain this transition of banks away from certain type of activities. And then, to the extent that technology allows and institutional details allow, you may actually see an alternative emerging, right? So this non-bank financial institution. We don't think, however, it's really the end of the story, because nevertheless, banks maintain this natural advantage at being intermediaries. That one has not changed to the best of my understanding. And that natural advantage is really the result that banks have, at least from an ex-ante perspective, exclusive access to official backstops. It's liquidity facilities, the guarantee of at least part of their liabilities, and that is what gives banks an edge that simply has not changed over time, It is what makes them able to source stable funding and to have also a special ability to manage liquidity risk. So those are kind of the premises. That's our conjecture. And so I mentioned earlier, why is it the case that there is maybe this dependence of NBFIs on banks? What justifies our point? Well, there is dependence to the extent that these institutions are, again, engaging in financial intermediation, and meaning that they are engaging in liquidity and maturity transformation, which means that management of liquidity risk is really, it's the bread and butter of what they should be doing. Okay, so they are in this business, so how can they do it effectively? How can they manage this liquidity risk? Again, we have a long history that has taught us that traditionally, the traditional intermediaries, which are the banking institution, have become stable in that business model only after being the recipient of credible support from institutions. And so now you have this new set of institutions, the non-bank financial institutions, that are engaging in intermediation. By, would say, definition, they do not have standard access to liability guarantees. They don't have access to liquidity facilities. How can they be successful? How can they grow as intermediaries? How can they credibly provide intermediation services? They still need to manage liquidity. So how can they do it if they don't have access to the backstops? They can buy these services. And who can provide those services? The banks. The banks, because they are the ones that have access to the backstops. So in a way, the banks are the ones that are passing on to this new set of institutions part of the benefits associated with their institutional role. So some evidence of that. This, what we are suggesting, should also predict a natural increase of banks providing funding to the non-banks, and we certainly see that, at least with United States data. I'm hearing that actually this is the same also in Europe. This chart here on the left is showing with very granular data, confidential information just on the banks that are subject to stress testing, that in fact, these are loans on the book of banks have grown quite remarkably in the last 10 years or so in the entire rainbow of NBFI segments that you can use to classify this entire ecosystem. What I think is actually more telling is the chart to the right, which is showing NBFI loans as a share of total bank lending. And the fact that it's increasing, and it's been a steady increase, to us corroborates the prior of a shift, a transformation of their activity away from the traditional segment, the real side of the economy, to the support of a new cluster of intermediaries that are then interfacing themselves with the real sector. Now, this is from the perspective of the banks. Is this actually relevant? I haven't really proven to you that NBFIs themselves are dependent on banks. It's very hard to assess that because almost definitionally, good data on non-regulated or less well-regulated institution is hard to achieve. We can look at it at a very aggregate perspective using a new tool of the flow of funds of the United States that had been put together about 3 years ago. I think we are still the only researchers that are using this for research purposes. With this new tool of the flow of funds, for the first time, we can actually see the funding interconnection between banks and NBFIs, all the sectors. So in other words, we can see at every segment as issuers of liabilities, and we can see which segment of the economy is holding those liabilities as their own claim. And so I can focus on banks as the holders of NBFI liabilities, and the data seems to suggest something that corroborates our point. They represent important chunks of NBFI's liabilities. 10% of ABS issuers' liabilities are held by banks, 25% of those the broker-dealers, REITs, and so forth and so on. Interestingly, banks are not as dependent on non-banks. Fundamentally, banks continue to fund themselves in the real sector. That is, again, a reflection of their deposit franchise, which is based on the reason that I mentioned earlier. So I think that is another important piece of evidence. It's not just what sits on the books of the banks. To me, actually, this chart is even more important. It is about providing contingent funding, right? So credit lines to NBFIs. That has grown at an order of magnitude even higher, as you can see on the left. And again, on the right, you can see evidence suggesting the shift of attention, if you will, from the real sector to NBFIs by banks. So I will conclude with what might be the implication of this empirically. As I mentioned at the beginning, the conventional view seems to predict maybe a greater insulation of banks now that NBFIs are taking a larger role in intermediation activity, especially credit intermediation. But our perspective, as you may have guessed already, in fact suggests the opposite, that if anything, the exposure of banks is increasing with respect to the counterfactual, where they were the only game in town. And especially the reason why there is this increasing level of exposure is that credit lines to non-bank financial institutions are especially difficult to price. And in particular, what is very difficult to price is the event, the materialization of states of the world where these credit lines are going to be drawn down all at the same time. And because these are NBFIs, there is a very high likelihood, they are all in the same business of providing credit, that in fact there is going to be a high chance of correlated risk. And that component of correlation of risk, the fact that credit lines may be drawn down above and beyond your expectation of individual obligors characteristic, is what we think can seep through and have an impact on banks. And so we should be observing in the data that there should be these systemic risk spillovers. One testable hypothesis that we entertain and we present in this paper is that you should be observing an increase in correlation of the systemic vulnerabilities of banks and NBFI sectors. In other words, both banks and NBFIs should be subject to, their systemic vulnerability should be co-moving, and that co-movement should be increasing over time as a result of this increase in interconnection. And that's exactly what we observe in the data. This chart is showing the correlation in changes in S risk between banks and NBFIs. That correlation is positive and certainly not small, because these are all financial firms pre-GFC. That's the base. But again, post-GFC, that correlation has just went up at very, very high level, and it has remained quite high. Of course, this is not causal evidence. We have another paper where we entertain more rigorous analysis that effectively confirms this point in a clearer place. So my last slide, summarizing with maybe some policy implications. Again, so there is a raising regulatory burden on banks, but that per se does not mean that banks are reducing their exposure. What we are observing is just a change in the nature of the exposure. And the second part of that sentence, may be provocative for this audience, for the discussion. I would suggest that at least part of the observed NBFI growth is really an artifact of regulatory arbitrage. And I'll be curious to see if I receive a lot of pushback on that. And so there is this transformational risk is going to lead to higher levels of risk-taking in the system. And the reason for it is that, again, there is actually increasing amount of intermediation activity that is moving in the hands of institutions that are less subject to prudential standards. And so they may have risk-taking incentives that are in fact larger than the one the banking institution would want to operate under, and that is going to create a lot of problems. Just minus 30 seconds to just suggest policy implication. The obvious one, and this is really the lowest hanging fruit, is the fact that, again, you cannot look at these two segments separately. You literally, it's almost as if you want to have one balance sheet that combines banks and non-banks. There are actually good recent examples in this direction. The Bank of England Suez initiative is one that definitely acknowledges the importance of these connections. Fed board in the very last round of stress testing explicitly focused on NBFI credit line drawdowns of banks, so that's, I think, it's very encouraging. Much less low-hanging fruit is how can you do this? You can perhaps try to regulate this type of risk through the banks. Collateral prepositioning sounded like a good idea until Raghu debackled that in his own remarks earlier, that it's always going to be a problem of time consistency in applying these rules. So we just leave it there, for cocktail conversation maybe. And even the worst one, I mean, this is definitely the highest tall order, ex post commitments. In other words, if a segment receives a lender of last resort services, that might be an indication that perhaps those segments should be subject to stricter prudential regulation. Again, easier said than done. I'm not paid enough to actually provide you with a solution for that, so I'll just leave it there on the table. Thank you.
Thank you, Nicola. We have two discussions because competition leads to risk-taking, I guess. The first discussant is Thomas Piskorski from Columbia University.
So thank you for the invitation to discuss this interesting paper. So what's the broad motivation for the paper? We all know the NBFI sector has grown quite a lot, and now the assets of NBFI sector surpass globally the traditional banking sector. Why are we potentially concerned about that? So the financial regulation has been mainly focused on traditional banks. The assumption is they're at the center of financial intermediation, but as we know, the shadow banking NBFI sector grow quite a lot. We don't exactly monitor it as well. We don't know exactly as well what they are doing. So, a lot of policy discussions are around, bank capital regulation, like Basel III Endgame. The US bank were pushing a lot against that. But then when we think about shadow bank sector, there are obviously the linkages between traditional banks and NBFI. So recently we have issues with a tricolor lender. It's a private credit fund that makes car loans. It's a typical non-bank lender because it actually borrows money from Barclays, JP Morgan. It doesn't have balance sheet capacity. It makes loans, but it subsequently securitizes. It's very dependent on debt securities market, capital markets for its funding of its loans. And this kind of linkages are also raising a lot of questions about financial stability, risk, and so on. So the way Nicola set it up, that we could think about different ways about NBFI sector. One is maybe they just really do something very different from each other. Another, maybe there's a substitution, and NBFIs are just taking the business of traditional banks. And they coined this term transformation view in the sense that it's really the interdependence between these two sectors. And in particular, the banks have deposit advantages. They can provide liquidity services and loans to the NBFI sector. And they viewed we have to really analyze them in conjunction and analyze equilibrium interaction between these two sectors. I just want to say that I broadly fully agree with this assessment. We kind of coined similar term, distributive financial intermediation. The idea is that really need to understand these interlinkages, and they're very important for evolution of these two sectors. So in terms of evidence, I think the paper provides a really nice evidence on the interdependencies between banks and NBFIs, the growth of lending of banks to NBFIs, including also the shadow lending through credit line commitments, the kind of work David and Victoria did a lot of work on. And case studies, an interesting correlation also that suggests the sectors are getting more and more moving together that sort of highlight these interdependencies. So the kind of broad implication, there is this nexus of bank and NBFI. I think it's an uncontroversial statement. We need to look on the entire sector from the regulatory perspective. More controversial things is like what to do about it from the policy standpoint. Some things they advocate a bit implicitly is extending liquidity guarantees to non-bank sector and so on, but obviously we need to think more about that. So in terms of my comments, as I said, I just broadly agree with the view that these sectors involve in conjunction. We need to really analyze them together. So what I want to do a little bit in my remaining time is to shed a little bit more light on the growth of NBFI sector, in particular adding that technology plays a very important role. They focus on the last 2 decades and they talk about regulation, but there's a lot of other things going on. I will show some additional evidence on risks in NBFI sector and traditional banking sector. And I will conclude with really kind of a need of a new model of financial intermediation. I'll show you some kind of outtakes of what such model might deliver from the policy standpoint. So first, let me show you, go to the US credit market and show you some kind of a big trends. So first, if you look on the lending, in the US in the 1970s, vast majority of loans were originated by banks and financed on bank balance sheets. So I'm showing you the fraction of lending that financed by banks to households and firms. Then it declined to only about a third. Note, this decline really happened before great financial crisis, before the regulatory tightening. So there's obviously something else been going on before. Now, of course, the banks also invest in debt securities once you add them, and some of these debt securities are actually issued by NBFI sector. But even with this, you see a significant decline in traditional bank financing to household and firms, which now accounts for less than half of the credit. So what are the underlying reasons behind that? It's really a lot of developments of the modern debt securities markets, think like CLOs, MBS, ABS, corporate bonds, facilitated by technology, development of computerized system, modern scoring that limits informational asymmetries, as well as regulatory support to that securities market. Think about government-sponsored enterprises creating a liquid market for mortgage-backed securities. So this is on the lending side, but since less lending is financed by bank, who finances it? If you look on the deposit as a share of financial wealth, the deposits become less important. They account for 20% of financial wealth in the 1970s. Now it's just a little bit above 10%. And why? We have developments on the saver side. Shadow money, modern pension funds, money market funds, debt fund ETFs. So essentially what happens is, as a saver, as an investor, I don't need to give money to bank through deposits and then they just invest it into loans. I can just give money to pension funds that buys debt securities that can be originated or created through the NBFI sector. And finally, if you look on the loan share of bank assets, they also decline. In the 1970s, 70% of bank assets were loans. Now it's only about 55%. And here, actually, regulation plays a role in it. You can see a decline after great financial crisis, the liquidity rules, and so on. But also, since loans become less special, banks also allocate more and more of their deposit funding towards securities. Now, what about risks? Just a quick reminder, we always worry about NBFIs, but really, at least in the US, the banks are very highly levered. A typical bank is 90% debt funded, 10% equity. Most of the debt funding is deposits, half are uninsured. So banks take a lot of duration and credit risk with a very high leverage. The SFB crisis and show it, the Fed raised rates, bank asset values significantly decline, and there was a ransom dozen of banks before the intervention. So on that metric, if you look on non-bank financial institutions, this is kind of an outtake from our work looking on mortgage lenders, they actually have substantially lower leverage. And there's an emerging amount of work showing this in different lending markets. For example, David has a work looking on business development companies that also show that private credit companies like that are also substantially less levered. So in that sense, the NBFI lenders appear to be less risky. This actually holds if you also control for asset quality. But then, of course, there's an issue of lending and dependence of NBFI on bank loans. Like this is from Erica Jiang job market paper. The banks really are main provider of credit to non-bank mortgage lenders. And a simple calculation with it shows that currently about $1 of non-bank lending is financed with about 8 cents of bank direct lending, plus there is the shadow credit lines. And it has been growing, which is consistent sort of with Nicola view. So what are the regulatory considerations? NBFI is growing, but they're dependent on bank credit. There's something special about deposit funding. And then obviously it raises question like what should be the regulatory perimeter, and ultimately we have to think about what the social objective is and what frictions we try to solve. Are we worried about runs in the NBFI sector? It depends on what type of functions they do and how separate they are. So generally what I just want to say that has the strengths of the growth of NBFI is going beyond regulation and global financial crisis, but obviously regulation play a role there. I think technology plays a very important role in it. In particular, we have a new wave of tech coming. Think about stable coins, DeFi, artificial intelligence, so that can erode further deposit advantages of banks. Obviously, from a regulatory standpoint, we have to be looking on these two sectors. It's always difficult because our regulatory agencies are siloed. So, the one focus on deposit insurance, one focus on other things. In Europe, it's even harder because you have different countries talking to each other. But as I say, we really need to think about it in a new way. We need a new financial intermediation framework that kind of structurally recognizes these linkages. It's just not a kind of a cheap bullet point. We've been thinking for several years about that. So in the remainder a couple of minutes, let me just show you what such framework might deliver, just to give you the teaser. So the way this is from a recent work with Greg Buchak, Gregor Matfos, and Amir Seru. So the way we think about financial intermediation, we have a saver sector that has money. We have the borrower sector that needs money. In a traditional bank business model, you had a banking sector in between them. Banks get deposits, they allocate them to loans and securities. But now we have this NBFI sector that also can lend to households and firms, that also gets money from the saver sector, but through different means. And there's this interconnectedness between these two sectors in two ways. First, banks also invest in debt securities originated by NBFI sector. Secondly, bank finance NBFI through loans and credit line commitments. And that's we need to kind of and then is of course central bank that also affects this through the reserves, through the quantitative easing policy and interest rate policies. So to really understand modern financial regulation and policy analysis, we really need to understand how the modern financial system works. And in the last minute and a half, let me just give you a teaser what such framework can deliver, and I'll just conclude. So imagine, for example, you would raise capital requirements on traditional banks. What will happen in this framework, you will see a significant decline in bank balance sheet lending. So if you just look on call reports, you will see less bank loans in relative terms. But the aggregate credit actually declines only very modestly. So what really happens is when you raise bank capital requirements on bank regulation, you have transmission of credit away, reallocation away from traditional banking sector towards debt securities and NBFI financing. So that suggests the policy trade-off is somewhat different. The regulation does not necessarily curtail the overall credit as much. It's more reallocates it away from more regulated to less regulated sector. And of course affects maybe who also can get credit. So these are kind of first order policy trade-offs. This is the last slide before I conclude. Think about monetary policy. This is based on our modern financial intermediation framework. We can decompose monetary policy into changes in interest rates and quantitative easing the purchases of assets. And generally when interest rates go down, all else equal, you're going to see more lending in both traditional and NBFI sector. But for example, if you consider quantitative easing policies, asset purchases, they again reallocate credit away from traditional bank balance sheets, direct loans, towards debt securities. Because if the central banks start buying debt securities, the NBFI sector can respond, and banks will respond to this too. So there's this important reallocation effects. So just to conclude, we really need to rethink how we model financial regulation, taking all these linkages together. And ultimately, we really need to seriously, once we understand how the system works and how it responds to various instruments, we have to really think about what is the welfare function we try to solve and how to sort of best address it.
second discussant is David Schaafstein from Harvard Business School.
Thank you, and thank you for the opportunity to comment on this very interesting paper. I think there's going to be a bit of a outbreak of agreement at a research conference, but I'll maybe try to say some things that folks might not agree with. As you know, the basic argument of the paper is to sort of outline these alternative views of the financial sector, and they propose this transformation view in which banks and NBFIs are dependent on each other, and they sort of make the argument that NBFIs seem to be more dependent on banks and vice versa, and that policy needs to take this dependence into account. My comments are going to focus, I basically agree that this transformation is happening and is ongoing, but I'm going to try to expand on the driving factors. Some of it will pick up on what Thomas was saying. And then I want to explore the implications for financial stability. And I'm going to do a bunch of this in the context of private credit, which is the NBFI sector that I have been studying. Interesting, this is speculation and maybe consistent with what the authors found in the paper, where it feels like the dependence is more that banks are less dependent on the NBFI sector for their funding versus the other way around. And it is interesting that like salient pre-GFC examples mainly involve and some of the stability risk were bank dependence on NBFIs and the market, right? Money market fund financing of banks, CLO purchases of bank syndicated loans, securitization of private residential mortgages, asset-backed commercial paper with bank liquidity backstops. And some of that really seems to be less than it once was. And the salient post-GFC examples involve NBFI dependence on bank funding, whether it's private credit funds, fintechs getting their credit facilities, private credit funds getting credit facilities from banks, warehouse lines to mortgage originators, and then banks purchasing and insurance purchasing senior tranches of CLOs. So it's an interesting question as to whether that, in fact, has something that's been changed, and it's a little bit hard to measure that, but it would be interesting to explore that. Okay, so I want to talk a little bit about why there's been so much growth in NBFIs and bank funding of NBFIs. And here I think the paper sort of talks about regulation, but I want to take a little bit more granular approach to that. So one explanation is that there's increased capital requirements post-GFC is moving activities to less regulated, more leveraged NBFI sector. Okay, this explanation just fails. And I'm not saying that that's exactly the explanation that they're given, but the NBFI sector is generally much less leveraged than the banking sector, particularly in private credit, even when you do it on a risk-adjusted basis. This is work that I've done with Sergey Chernenko and Robert Iolente, and in non-bank mortgage origination in the paper by Zhang that Thomas and Amit co-authored as well. So you need, but I would say pre-GFC, that felt like a pretty good story. Like if you look pre-GFC, what you saw was a lot of non-bank financial entities, GE Capital, CIT. These were non-bank financial lenders. They're the sort of private credit funds or private credit entities pre-GFC. They were much more highly leveraged and short-term funded. That is not what we're seeing today. So private credit funds tend to be much less leveraged, and they have leverage that's sort of on the order of, just debt to not risk-weight adjusted assets of like 50%. So capital of 50%. So that story doesn't quite work. So I think there's a number of other factors that combine to help explain the growth. And again, this is sort of in the context of private credit, but I think it's broader. So post-GFC capital regulation and supervision has made safe lending relatively more attractive than risky lending. So like if you do the analysis, the implicit risk weight on a leveraged loan is greater than 100%. So leveraged loans is essentially what private credit is. They're making loans to private equity to help do buyouts of private equity sponsored firms, while the risk weight on loans to private credit fund is just 20%. So it's structured in a way that when a bank is making a loan to a private credit fund, it gets a 20% risk weight. And it's treated as a securitization and a senior tranche in that. So there's a really big difference between making a loan to a private credit fund and making a loan to a non-financial borrower. And we kind of go through the economics of this, and the return on equity for that loan looks a lot more attractive. I think a second part of this is that banks have no origination, underwriting, and this is an extreme statement, servicing edge in lending to private equity sponsored firms, which is what private credit's about, to homeowners, to consumers, and to small business owners. It's a combination of technology, and it's the fact that private equity sponsors, they're not, the bank, you think of the bank as having a branch network, being in the community. You don't need to be in the community to make a loan to a private equity sponsored firm. And there may even be a disadvantage given supervisory costs and restrictions. We do some analysis in some of our work where we say, actually, if you look at what when banks talk about getting into private credit, it's not on balance sheet, but it's rather off balance sheet through their asset management businesses. And that implies that there is a cost, and they're doing it in a more, in a less leveraged way, with more capital backing it, and with higher funding costs. They're not funding it on balance sheet. Why is that? That has to be saying something about what the supervisory costs and restrictions are. And then the third point, and Thomas also mentioned this, is the increasing institutional demand for fixed income assets, right? With greater wealth, retirement wealth, and other forms of wealth, there is a lot of demand to actually directly hold assets rather than holding, bank equity. Low-risk lending to NBFIs exploits the edge that banks do have, okay, namely low-cost funding and access to liquidity backstops, and does not require a costly origination platform. So I think those are some of the factors that are driving that growth. So I also want to talk about financial stability implications. And what are the risks associated with bank funding of private credit funds? And so this is work that I've done with Sergei Chernenko, where we do basically stress tests on private credit funds using data on business development companies, which are essentially a type of private credit fund. They give a really good glimpse at the private credit space because they are sponsored by asset management businesses that have private credit funds, and they have these BDCs. They hold pieces of the same loans. As I mentioned before, these BDCs, I shouldn't say, it's not banks, it's BDCs, have capital of about 50% of assets, which are not risk weighted. If you do the risk weighting, it's like 30 to 40%. And those stress tests reveal very high stressed capital buffers. Typically, bank loans to private credit funds require that the assets backing those loans exceed 150% of the borrowed amount. This is this notion of an asset coverage ratio. And this over-collateralization is the key to getting favorable capital treatment. So to get that favorable capital treatment, banks protect themselves by over-collateralizing those loans. Now, importantly, what are the stability implications of this? That over-collateralization protects the bank lenders against the losses over the stress scenario. But these loan covenants and regulatory requirements lead private credit funds to deleverage to stay in compliance. So we do a simulation where we say how much deleveraging would there have to be to stay in compliance with these ACR, asset coverage ratio, loan covenants. And what we see is that the BDCs, these private credit funds, are going to use loan repayment proceeds to pay down debt rather than to reinvest. And they may have to sell assets if it's possible. It's not exactly a liquid market. And the extent of deleveraging is going to depend on a variety of factors, including how the BDCs are funded. So I would say like the risks to banks, and this is, maybe a controversial statement here, but the risks to banks are limited, but the deleveraging of the NBFI, the private credit funds, may be more concerning. If you look at during the GFC, banks were protected even as a number of risky BDCs defaulted on loan covenants and significantly deleveraged. So the regulatory apparatus is protecting banks, but potentially exacerbating deleveraging in private credit funds. So let me just conclude briefly with, emphasizing the point that the main risk may be about related to deleveraging. I agree with Nicola's point that credit line drawdowns by private credit funds during stress conditions could limit the ability of banks to lend to others. And that's something that we really do need to think about, that even though banks are protected, the drawdowns could lead to a deleveraging in some sense of the banks themselves. Some questions to think about is, do deleveraging risks of this sort require a policy response? Okay, is deleveraging excessive relative to a plausible benchmark? Would there be less deleveraging if these NBFI loans were instead on bank balance sheets, which are, by the way, much more leveraged? And are there policy responses that could mitigate the problem without exacerbating others? And then finally, these are questions really, I don't have the answer. Should NBFI growth funded by bank lending be a cause of concern or potentially of celebration? In some sense, it de-risks bank balance sheets. It moves credit creation to less leverage entity, maybe less deleveraging, that's the positive. On the other hand, there's obviously been a boom in private credit. One has to take account of that. Is that leading to excessive leverage in the non-financial sector, both households and firms? And is it concerning that the NBFIs might have, again, excessive leverage, not access to lender of last resort facilities? So lots to think about that this paper brings up, and look forward to any discussion that we can have.
Thanks, David. Let's open it up for Q&A, Nicola, if you're okay with it. And maybe while you're answering, you could bring in some of the points that you wanted to address, what the discussants brought up. So as you ask a question, I've been asked to tell you to stand up while asking the questions and speak to the microphone. Any hands?
Hi, Amr Sufi, Chicago. This is just reiterating a point that David was saying, but I would push a little bit on. If you look at the private credit funds, which are the other major source of financing in private credit other than business development companies, the Federal Reserve put out a financial stability report in May 2023. We have access to Form PF on one of the research projects I'm working on. They're remarkably unlevered. And again, it's the Federal Reserve, so if someone's supposed to be watching out for this, it's them. And they basically say the financial stability concerns are minimal with private credit funds because they're using such a little amount of leverage, far less than the business development companies either. So I guess in the context of private credit, there may be a bit of pushback that the parallel view in private credit is kind of the right view, that it does seem like there's a specialization of private credit funds in a particular type of business, private equity sponsored businesses, that really doesn't rely on banks almost at all in any part of the intermediation chain. So I agree, obviously in subprime auto, we know there is some important, but it seems like the most explosive growth in the non-financial business sector does seem to be happening largely independent of banks, or at least a lot less than banks than we may guess otherwise. That's in the US. I don't know what the European experience is. Maybe it's different in Europe.
Yeah. No, thanks for the question. Thanks for bringing the private credit funds in the picture, which is remarkably a recurrent refrain when we have these conversations. So you mentioned that report from 2023. A 2025 report of the Federal Reserve actually now is pointing at, in greater detail, at, again, the exposure of banks through credit lines. And the fact that those have grown a lot, and as well as, in support of the business of the private credit funds. And so it is true that those vehicles have very little financial leverage, as I think Thomas was mentioning in his remarks. And yet, they depend extensively on bank credit lines for their business. And in fact, the fact that they are effectively funded by equity, but they use the credit lines to manage the equity flows, the capital calls, or to avoid potential unscheduled capital calls. And so that credit line that the bank provides to a private credit fund is effectively encouraging the equity investment in these vehicles. So I wouldn't be so, I would be a little bit more, I think it's a little bit more intricate as a story. It's not that they do not have leverage. They still have a lot of reliance on contingent type of funding, right? So if those credit lines are going to be drawn down, that's going to be materializing on their balance sheet. So I think that there is actually an implication there where there is, I don't know if you want to call it hidden leverage or mask leverage, or at least the need to consider that business activity in combination with the provision of these liquidity services by banks. I think that's an important point, which ties me, to the comments that David made. And again, he's right. I think we agree way more than what we disagree. In fact, I would need to nitpick to see in what way we disagree. But I would want to stress the importance. At the end, you were talking about the systemic implications, that maybe the banks are protected. It's just that there may be some sort of fire sale externality due to the deleveraging of these funds. But I want to point out at this risk correlation associated with the drawdown of credit lines of the private credit funds. And again, I don't have strong empirical evidence on it, but let me just use one anecdote that I think we report still in this paper. In March 2020, Blackstone, that is one of the largest private credit funds, actually, when they were facing their own liquidity stress because their clients needed additional funding support, the non-financial clients of Blackstone instructed their clients to draw down on their own bank credit lines, at the same time that they were presumably also tapping on their own credit lines. So that's the scenario of risk correlation that we have in mind when we are sort of suggesting that there may be systemic spillovers larger than what, again, might be observable on the surface, and so that actually banks may be not as protected.
Thank you. Oreste Tristani, ECB. No, I was just wondering, you emphasized a lot the financial stability implications, but also tying this up to the keynote speaker. I was wondering whether you have any views on the specific implications of your transformation view for the transmission of monetary policy. So the first discussant also alluded to this.
That's part of our research program and the research program of many other people, I think, in this room. I mean, monetary policy in such a more intricate financial ecosystem, I think really requires revisiting all the transmission mechanisms. We have in mind the traditional lending channel monetary policy through the balance sheet of the banks, but in a world where banks are shifting their funding liquidity provision away from where monetary policy would want to actually have an impact and toward this new, sort of intermediate link of the intermediation chain, I think requires investigation, right? Because I don't know really what is the sensitivity of lending of banks to non-banks as a result of changes in monetary policy, because that is going to be another channel of transmission of monetary policy eventually to the real sector in ways that definitely is much more complex than in a simple setting as the one that Thomas was showing at the end, right? Savers, investors, and simple intermediary in between. So I don't have an answer, Oreste, sorry.
Enrico Perotti, University of Amsterdam. So I am convinced that private credit and private equity firms running this operation are very, very broadly equity funded, but this is a thin layer between the real sector firms to which they're lending and the rest of the financial system. I mean, what is happening in private equity, in private credit and private equity is a lot of capital extraction from non-financial company. It's a lot of leveraging, it's a different business model, long-term term loans from private credit, substituting what used to be equity. And of course, close management, supervision over management to control the risk. But ultimately, we have levered up a subset, and a growing number of non-financial firms to a very high degree, with very competent, I'm sure, oversight by private equity and private credit, which are very linked and operating in conjunction. So I think the fact that there is some equity in between the one holding this company doesn't entirely reassure me that if the crisis were to come from the real sector, it wouldn't be really very difficult for these intermediaries to carry beyond, to carry the losses at the underlying firm. So we can think of the shock as being financial, in which case indeed is what David says. It would be liquidity problem in selling these stakes, but it could truly be that these firms are extraordinary leverage. This is the Jensen idea of substituting debt for equity and squeezing everything out of it and paying it out. Well, it's been paid out, and there are a lot of firms now that are held, but is, under leverage, thin layer, and ultimately, as the sort of companies that, the sort of trust company that were holding supposedly safe asset in the financial boom had huge credit lines with banks. Banks claimed these were sort of bankruptcy remote, but when the trouble came, of course, the credit line became equity in failing constructions. Thank you.
Very quickly, I agree, I think, with a lot of what you said. We may have to cite you in the paper. Now, one thing that I wanted to mention, which is about, again, still on private credit related to Amir's question before, it's interesting, in another event a few months ago, sponsored by ECB and Hoover, when there was a panel actually that also had private credit fund managers. I thought one, to me at least, very insightful remark by one of the largest private credit fund manager was that, yes, we would not, I think you were there, we would not be able to operate without the support of the banks. Or, I don't know if that was exactly the language. Unfortunately, I don't think it was recorded. But I thought that was actually quite insightful. And again, I don't want to take it as a corroboration of, of our prior. I think it really speaks to, the point that Enrico is mentioning is that, it's maybe a little bit more complicated than what it seems.
One last question. Jit Kapadia from the ECB. So thanks, really great talk. So you focused a lot on sort of the bank versus NBFI split, but I just wondered if you could comment also on just the types of financing. So you could also think of like a loan financing versus a market-based financing type split. And at least in Europe, loan financing is the vast majority of loan financing is financed by banks, whereas debt security financing, market-based financing, and the discussion also picked up on this, is much more mixed and much more financed by non-banks. And I wondered in the context of that type of split, at least in Europe, whether it's more a substitution effect because there's been a lot more of issuance of debt securities as post-GFC, the types of corporate issuance, sovereign bond issuance and so on. And is that more of a substitution type story if you think about the types of financing, which is a bit different from the institutional bank versus NBFI type thing, but it's obviously closely related because of the NBFI role in debt securities and banks' role in loans, certainly in Europe?
No, thank you. We would be definitely on the wrong side of this conversation if we were saying everything that is happening is driven by this transformation. We try to hedge in the paper. Maybe we have to hedge a little bit more. Of course, we need to also acknowledge that there are other drivers that explain this co-evolution, these dynamics of NBFIs and banks. The development of capital markets is certainly central to that. I think again, if I can sort of point the attention to our research, given my role here today, is that I think we would encourage a closer scrutiny on exactly what drives those developments, including the development of market-based finances. I think at some point we were talking about the explosive role of pension funds as another vehicle that for sure itself can fund non-bank institution, but it's a little bit of okay. Let's trace back all the way to the primitives, to the fundamental drivers, and again, I am still in the camp of really pointing the attention to this asymmetry that modern societies operate under, which is to grant specific rights to a specific type of institution, the banks. And with that comes, I think, a lot that drives dynamics of the entire financial infrastructure, right? So even if you want to model modern financial intermediation, I think you need to have as an ingredient this important asymmetry. So that opens up the question, David, I think, had a bullet point in the end. Maybe we should, I don't know if that's what your intention, we should be providing backstops also to the NBFIs. I think it's the topic of maybe the next paper. And I think that's, yeah, sure, that's an open question, but very, very provocatively, I would say that that is probably what would kill banks once and for all, which may be perfectly fine, right? So if you are going to eliminate that sort of special role that banks have in a system, I think that will do it. But then again, collectively, we will have to engage and understand how to take care of, of these systemic risks. Now you would actually have a new set of institutions that really are involved in financial intermediation activity without any sort of at least private sources of support that the banks previously would have. And then you have to we need to have an adult conversation that is, at the end of the day, bank-like activity that needs to be subject to prudential standards, which means that if you're doing that activity, probably you need to have the name bank on the door outside. So, we come back, I'm sorry, I think we're always coming back to the same, fundamental core.
All right, thanks, Nicola. Thanks, Thomas. Thanks, David, for the session. There are more questions, I'm sure. We can do that over lunch. And with that, I need to close the session. All right, welcome back. Please settle in. We are going to be continuing our first session, which you might remember before lunch was called non-banks. It's still non-banks. We have the second paper, which is Do Non-Banks Need Access to the Lender of Last Resort? Question mark. Evidence from fund runs. And it's going to be presented by Marie Herova from ECB.
Thank you so much. I would like to start by thanking Amit and Ross for putting the paper on the program. This is joint work with Johannes Breckenfelder, also my colleague from the ECB, and I should stress that the views expressed are solely our own. Well, we already heard in the President's speech, and also Nicola highlighted how important non-banks have become. In the euro area, they account for close to 60% of financial sector assets by now, and they also became a significant source of financing for corporates. As the importance of non-banks grew, so did the concerns that risks in non-banks can adversely affect financial stability and monetary policy transmission. And I think it's fair to say that what happened in March 2020 led some credence to these concerns, whereby we saw an unprecedented liquidity crisis in the investment fund sector, and I will illustrate on the next two slides the extent of this crisis. And whenever there is a liquidity crisis somewhere in the financial sector, inevitably the question is asked, do non-banks need access to the lender of last resort? Should there be some kind of access? And with this work, we will try to provide an input into this debate. So what happened in March 2020 with investment funds? Well, there were runs on euro area mutual funds, and this chart here illustrates that. It shows you aggregate net fund flows in percent between February and April of 2020. And it's inflows minus outflows. So whenever you see large negative bars, this is outflows, net outflows from the funds. And this is actually investment grade bond mutual funds. And that's exactly what we saw in March 2020, large negative bars. The peak outflows reached about 0.5% of total net assets in this sector. And there are also some vertical bars in this chart that indicate central bank interventions that we shall study in this work. These outflows were unprecedented in scale, and they largely affected bond funds. Just to give you an idea of magnitudes, about 150 billion euros were withdrawn from euro area bond mutual funds in the course of just a few weeks. This was not confined to the euro area, these exceptionally large outflows. We also saw them in US bond mutual funds, particularly corporate bond mutual funds, as documented by Falato et al. And very importantly, this crisis was not really just confined to this sector, because what happened is as funds faced runs, they had to fire sell assets, and that put strains on broader financial markets. Again, it's documented by a number of papers for the US, but also in the euro area, investment funds were the largest net sellers of assets in March 2020, selling more than 200 billion worth of assets, again, in the course of just a few weeks. What we also document in the paper is that funds faced a dry up in repo markets. So when a fund needs liquidity, it can sell the assets, or it can repo those assets to get liquidity quickly. And what we document is that it became increasingly difficult for funds to do so. Here is a chart that illustrates that. It shows you new bank lending to funds in the repo market in billions of euros, again, between February and April of 2020. And banks are really dealers in this market. And what you see is that bank cash lending to funds dropped by 50% between February and March 2020, from 30 billion a day to 15 billion a day. And again, there are some vertical bars in this chart that shows central bank interventions that we shall study in this work. So this dry up in repo markets further aggravated potentially the liquidity strain that this sector faced. So what do we want to do in this paper? We want to use this crisis as a laboratory to assess the impact of two ECB interventions. We will study what I call direct interventions, asset purchases, and the way we think they may be helpful to funds faced with a liquidity crisis is that they may attenuate fire sales, directly support market prices of assets held by funds, and thereby stabilize outflows. We will also look at indirect interventions, meaning the bread and butter of central banking, providing liquidity to banks. And here we will ask, do banks channel this liquidity that they obtain from the central bank to funds? We will be looking at the repo market. Again, the idea is it might reduce fire sale pressures. Why do we think this is an interesting laboratory? Well, first of all, the trigger was exogenous, pandemic-induced. that led to aggregate dash for cash in the financial system. Second, we think the euro area setting is particularly interesting because the ECB didn't set up any new facilities to deal with this crisis. It basically used the existing tools. And another advantage of looking at the euro area, among many, is that we have very granular data on funds, on banks, including their lender of last resort access, and also on bank fund trading relationships in the repo market. And much of the data we will use is daily, which is going to be very important because, as you will see, there were several interventions in quick succession. So it's nice to have daily data to have some hope of discerning what was going on and what was the impact. So what I would like to do is I would like to tell you what we find for direct interventions, asset purchases, and their impact on funds. Then I will talk about indirect interventions and their impact on funds. And I will conclude with some thoughts on policy implications. So let me start with asset purchases. We're going to look at the impact of purchases on fund performance and flows. And we are going to zoom in on the new program that the ECB announced, called the Pandemic Emergency Purchase Program, or PEP for short. It was announced on March 18th, 2020, in the evening after the markets closed, including in the US. And it started being implemented, meaning the first purchases took place as of March 26, 2020. In this part of the analysis, we will focus on bond mutual funds that invest in investment-grade securities and hold a non-zero share of euro area securities in their portfolio. Why this particular set of funds? Well, because we want to have a relatively homogeneous set of funds ex ante before the interventions took place. So we want to look actually at investment-grade funds. And we also want to look at funds that have a potential to be affected by what the ECB does, meaning they have some exposure to the euro area. And then we're going to do something rather straightforward. We're going to compare funds with higher shares of PEP-eligible assets ex ante. We're going to look at their portfolio holdings in January 2020. And we're going to compare them with funds that have lower shares of assets that are eligible for ECB purchases. You might be wondering what the difference is related to, for example, to holdings of bonds issued by US issuers or by euro area banks, who are very large corporate bond issuers in the euro area, but neither of these type of securities are eligible for ECB purchases. So what was the PEP impact first on fund performance? And this is really a chart that tells the story, I think, very nicely. It shows you fund market value change in percent between February and May of 2020. The performance is normalized to 0 at the beginning of February of 2020, and then it's traced over time. And it is plotted for two groups of funds. In solid blue are the funds that have higher eligible holdings, ex ante, for ECB purchases. And in dotted red are the funds that have lower eligible holdings, ex ante. What is interesting to notice is that the performance of these two groups of funds is remarkably similar all the way until the ECB intervention on March 18, including this precipitous decline in performance in early March. But what happens on March 18, in fact, the vertical bar here is on March 19, which is when the markets open after the PEP announcement. You see that the performance of the group of funds in the solid blue line jumps immediately and continues trending upwards, whereas the performance of the group of funds in the red dotted line continues to decline and only recovers gradually later on. And I will talk actually about what caused that recovery or what helped that recovery. Again, this is just data for now. We put this data into a diff setup. And what we find is that after PEP announcement, a gap between this higher and lower eligible groups develops. And this gap is equal to 3.6 percentage points in the week in which PEP was announced. It is 2.6 percentage points in the first implementation week, declines to 2.1 percentage points in the second implementation week, and thereafter becomes insignificant. Okay? So on announcement, we find very strong effects. And this is actually an important result because we know from prior literature that bad performance can trigger outflows. So presumably, if PEP managed to put a floor and improve fund performance, it might have also helped with runs the funds face. So this is what we test next. Here is our results, diff and diff, in the format of a table. So again, what we're interested in is the differential between the group of funds that have more PEP-eligible assets compared to the group of funds that have lower PEP-eligible assets, and this is the differential that is here in this table. First thing to note is before the intervention, there is no difference between these two groups of funds. But then, in the week of PEP announcement, we see that the differential develops. Just to give you a sense of magnitudes, the funds that had lower PEP-eligible assets still face daily outflows of minus 0.5% of their TNA, total net assets. But the funds that have more PEP-eligible assets had lower outflows by 0.323 percentage points. And that means, in relative terms, that net flows in funds with higher eligible holdings were actually up by 62% after PEP announcement. We find that by the end of March, runs pretty much stopped and flows largely stabilized in both groups. So we no longer find statistically significant differential after that PEP announcement week. We do a few additional analyses. Let me share two analyses with you. First of all, we find very strong announcement effects, and the question is why. So what we do here, we investigate the role of PEP flexibility. It's the feature of PEP that allowed ECB to temporarily tilt its asset purchases towards certain issuers. What we do here is we split funds into more versus less exposed to the most indebted euro area countries within the more eligible group. And indeed, we find a performance differential of 2.6 percentage points in the announcement week, which means that those funds that were more exposed to the more indebted euro area countries benefited even more from the PEP announcement. We also control for US Fed interventions, and there were two large interventions on March 23rd and on April 9th, 2020. What we do here, we're going to double sort funds on both their PEP and on their Fed eligibility. And we are going to also include daily dummies to zoom in more closely on the impact of interventions day by day. So here are the results, and I'm showing you the performance differential in percentage points. First, for the group of funds that have ex ante more PEP-eligible assets. And what you see here is upon PEP announcement, which is the first vertical bar, PEP announcement on March 18th, the performance of funds that have more PEP-eligible assets jumps upon announcement by more than 1 percentage point. It continues trending up. It remains statistically significantly higher compared to the other funds, decreases after about 2 weeks, and is eliminated, this positive differential, with the second US intervention on April 9, which was shown in the literature to be very impactful. Okay? What did it do, that interventions? It lifted the performance of funds that had more Fed-eligible assets, and that eliminated the differential. What is also interesting is to look at the group of funds that have both a lot of ECB and a lot of Fed-eligible assets, and this is what this chart shows on the right. Again, it's performance differential in percentage points. What you see again, with the PEP announcement, performance jumps upon announcement, stays positive, and what the US Fed second response on April 9 does is that it keeps going, this differential, it remains positive for some weeks to come. So this is for the funds that were lucky enough to have both a lot of PEP and Fed-eligible assets. In sum, even when we control for Fed interventions, we find very strong PEP announcement effects on fund performance, but also on fund flows. Okay, let me go to the indirect interventions, so central bank liquidity provision to banks. And what we will be interested in is to look how that central bank liquidity provision to banks translated or not into bank repo lending to funds. What we are going to zoom in on here is new long-term refinancing operations, LTROs for short. We always have lots of acronyms in central banks. And these particular LTROs were called bridge LTROs. They were announced on March 12, 2020, were conducted weekly, and all matured on June 24, 2020. Why this magic date? Because there was already a pre-planned large liquidity providing operation on June 24, and these operations were meant to bridge the time until that large operation. What we will do here, we will focus on relationship an investment fund had with banks prior to the crisis. Bank fund relationships in the repo market are sticky. They don't really change over time, we find. And we will focus on funds that have at least 2 such bank relationships so that we can control for fund-specific effects using Quadjamil methodology. Now, we need some cross-sectional variation of banks. We want to test kind of the bank lending channel. So we are going to compare bank repo lending across banks with higher versus lower exposure to the pandemic-induced liquidity crisis ex ante. We're going to explore 2 different cross-sectional splits, one on commercial paper rollover and one on excess reserves banks hold. So let me tell you a little bit more about these 2 splits. Here is a chart that illustrates why we think it's interesting to look at commercial paper market. And what is interesting is that by mid-March, this market basically came to a standstill. So this chart shows you the issuance of bank commercial paper in billions of euros, and you see by mid-March, it was basically impossible to issue any commercial paper. And so what do? We will split banks on those that had commercial paper maturing in March 2020 versus those that didn't. And this will give us a measure of bank funding liquidity needs, own funding liquidity needs. We will explore also a second split on excess reserves. So we will take excess reserves bank held as a ratio to their total assets, ex ante, as of January 2020. And this will give us a measure of readily available liquidity banks had. And then armed with these two splits, we are going to test how bank repo lending to investment funds changed. First, following the announcement of the bridge LTRO compared to the previous week. And second, following the settlement of the first bridge LTRO. What does it mean, settlement? It means that those banks that ask for central bank liquidity actually receive that liquidity on their balance sheets. Okay? And again, we're going to compare to the previous week. We will stop after that. The reason being is that many other interventions happened after that first bridge LTRO settlement, so it becomes very hard to isolate different effects. But also because this first bridge LTRO was actually the largest operation of its sort, both in terms of the number of banks that came and in terms of the allotted amount. So it's an interesting operation to study. What is our underlying hypothesis? Banks that were more exposed to March 2020 liquidity crisis themselves should be relatively more affected by the central bank liquidity provision, and we will trace whether they pass on that central bank liquidity to funds in the repo market. First question is what happened in the announcement week of bridge LTROs, and the answer is nothing happened. Okay, we don't see any differential impact of the announcement, and our interpretation is when the problem is liquidity, just announcing future liquidity provision is not going to make a difference in terms of bank repo lending to funds. Perhaps the actual provision of liquidity might make a difference, and this is what we are looking at next. Here are our results for what happens in the week of the settlement of the first bridge LTRO operation. It's also when the PEP was announced. And the variable of interest is this exposure dummy. Is it the bank that is more exposed to the March 2020 liquidity crisis, either because it has commercial paper coming to maturity and has difficulties rolling it over, or because it has lower excess reserve holdings? We have these two splits, commercial paper split, excess reserve split, and we measure repo activity in two ways, by the change in transaction volumes or by the change in the amounts outstanding, so flows and stocks, if you will. But no matter what we do and no matter what split we use, the result is always the same. More exposed banks lend more in the week when the first bridge LTRO was settled. And so both the transaction volumes and repo amounts outstanding are going up. To give you a sense of magnitude, they go up for this more exposed group of banks by about 60% compared to the previous week. So it's actually quite a large increase. Okay, banks lend more, but does it have any impact on funds faced with runs? What we do here, we compare outcomes across funds with and without prior relationship with the bank that actually got liquidity in the first bridge LTRO. We think of it as with and without indirect lender of last resort access, if you will. What do we find? We find that after the first bridge LTRO, funds with that ex-ante LTRO bank relationship had higher repo borrowing from the banks that obtained LTRO liquidity, and had also higher performance and flows even after we control for PEP eligibility, for the share of PEP eligible assets they hold. Now, I want to caution here that, at least from the data we are looking at, it doesn't seem to us that repos is really a panacea for funds in two ways. First of all, repos are not widely used by funds. We estimate that only about 5% of bond funds in the euro area actually use repos. Second aspect is that repos are actually not easily scalable for funds because of the regulatory leverage limits they face. They can only lever up in Europe up to 10% of their net asset value. So if they face large outflows, which many of our funds did, it's going to be difficult for them to cover those outflows by repo borrowing because they will hit that limit. By contrast, direct interventions, asset purchases, actually do not add any leverage. So they have that particular advantage in a crisis. So let me conclude with some policy implications. Do non-banks need access to the lender of last resort? Should funds become eligible central bank counterparties? Should there be new dedicated credit facility, perhaps just in crisis times? Well, first, let me say that there are lots of challenges of granting funds and non-banks more generally access to the lender of last resort. There are operational challenges. There are many thousands of funds just in the euro area. There are also those regulatory limits on fund leverage. It's going to also make it difficult for funds to borrow from the central bank. And there are, of course, potential additional risks that come with the access to the lender of last resort. What this paper showed is that applying the existing toolkit during March 2020 was actually helpful. Asset purchases, let's think of it as market make of last resort interventions, were very effective. Fund performance improved upon announcement, and outflows stabilized very quickly. Central bank liquidity provision to banks was also helpful. It did support bank repo lending to funds. So we view this as a potentially useful input into a cost-benefit analysis of granting access to non-banks to the lender of last resort. Thank you so much.
Thank you, Marie. We have two discussants. Our first discussant is Jean-Charles Rocher from Toulouse School of Economics.
Thank you very much. It's a privilege being here to discuss this very interesting paper by Marie and Johannes. Let me go into the motivation first. So, as Marie explained very clearly, central banks are concerned that runs on the mutual funds could destabilize bond markets, and this actually happened in March 2020. And the Fed reacted by creating new facilities, whereas the ECB decided to use traditional tools, particularly the LTROs, and also expanding large-scale asset purchases. And the idea is that the banks that receive liquidity assistance from the central banks would rechannel the funds, the liquidity to the funds. It's kind of a trickle-down theory of liquidity. And the main objective of this paper is to test this assumption. So what the paper does is basically to study the liquidity crisis of March 2020 and the reaction by the ECB. And indeed, there was a massive outflow from bond mutual funds threatening the proper functioning of bond markets. And the ECB reacted in two ways. One is expanding its asset purchases program. And actually, there is an unfortunate typo. It's not PEEP, but PEP, so it's involuntary. But the other tool was to provide additional liquidity assistance to banks through the bridge LTROs. So the main result is that indeed the funds with higher proportions of security eligible to PEP had higher returns and lower outflows. And the banks that borrow from in LTRO passed on this liquidity to the funds. So it shows that the ECB managed to support indirectly the funds that were hit by runs simply by providing additional liquidity to banks so that the banks could sort of recycle this liquidity to funds. And so this suggests that there is no need to make lender of last resort accessible to non-banks. I will come back to this, but my main objective here in my discussion is not so much to discuss the empirical strategy, but more to discuss the foundation, the justification, and the modalities of lender of last resort operation in the 21st century. So let me, I mean, you already know that, but it's important to start with the old Beige-Hot doctrine of the lender of last resort that was based on the observation that illiquidity problems, such as runs, can force solvent banks into bankruptcy, which imposes obviously a big stress on the financial system. And this stress can be avoided if the central bank is ready to provide emergency liquidity assistance. Basically, the Beige-Hot doctrine has 3 points. First of all, you need adequate collateralization to protect the central bank for credit risk, and to second, to charge a high interest rate. But the question is, as Raghu pointed out this morning, it's not clear how far you can go on that, but it's an instrument to limit more hazard. And then there is this notion of potentially unlimited intervention to reassure investors. So many central banks have adopted this doctrine, but sometimes it was twisted to bailouts and solvent banks and increasing moral hazard. And now, and I'm very much in line with what Nicolas presented this morning about the transformation view. I really believe that we are seeing a transformation of financial systems, and therefore maybe the way we react, the way we regulate financial institutions and the way the central banks intervene should also be transformed. And in particular, I believe that they should be the analogous to this doctrine. We have to develop a doctrine for a market maker of last resort. If we want really the central bank to act as a market maker of last resort, what does it mean? When and how should the central bank intervene? And more importantly, why? What is the objective? Is it really correcting market imperfections? Well, there are so many market imperfections that it would be really endless. So I really believe we should develop an analogous to this doctrine for the market maker of last resort. And it's a completely different object. We are not trying to rescue individual institutions. We are trying to protect markets. And that's a completely different setup. So the first thing of course, I understand that Marie didn't want to go into that, but I believe that in the back, this aspect should be discussed. The other aspect is notion of enhanced lender of last resort. The wider set of collateral eligible for lending to banks, outright asset purchases, including private paper, and also the US reaction, which was to create a new facility. Every time there is a problem in the US, they create a new facility to deal with these problems. And I believe that the two views, the US and the European view, have different implications for regulation. I believe that regulation and the safety net is a kind of, quid pro quo, whereby banks accept to be regulated in exchange for access to the lender of last resort. So I believe that if non-banks have also access to a lender of last resort, in the US view, it would be fair to ask additional regulation on those non-banks. But if you adopt the European view, which is that we don't need any specific facility, but it's instead the role of the banks to support the funds, then we need maybe to investigate in more detail what the banks are doing and maybe regulate more the banks' funding of non-banks. And in fact, you have exactly the same debate in the payment industry. In the payment industry, we have non-banks entering the markets, the so-called payment service providers. And if you want to have access to the payment system, you have to fulfill a certain number of regulation, which is relatively light. But those payment service providers are regulated in some way, are monitored by some institution, not necessarily the central bank, by the way. And so I believe we should do the same for this liquidity provision. In the payments industry, if a payment service provider wants to provide credit, then it has to become a bank. And so maybe the idea is that if non-banks want to expand its domain of activities, maybe it should also be regulated as a bank. So this is one of the points I would like to accept. The other thing is it's not entirely clear what is the main objective. That is it ensuring financial stability? Is it safeguarding monetary policy transmission? Or is it supporting credit to the real economy? And of course, the three objectives are not completely distinct. So I believe that the paper could discuss, or should discuss, the distinction between interventions that are ad hoc interventions after specific events, and the word last resort alludes to that. You want to do that, it's exceptional circumstances, when there is a market freeze, when there is a run on a mutual fund, then there is some kind of intervention, but then this should be also clear what the purpose of this intervention is and what conditions, what instruments should be used. But there is a different thing, which is the recurrent intervention motivated by enhancing monetary policy interventions. And I believe that this is an important issue, and the paper is really interesting because it shows that maybe the European approach works well, that you don't need to create these new facilities to support non-banking financial institutions, because I believe the US regulatory landscape is already quite complex, so you don't want to add other layers of complexity. But it's important to clarify the justification for the tendency of central banks to intervene more and more in financial markets. What is it that you want to do and why? And in particular, there is always this trade-off between financial stability and moral hazard, but how do you do that concretely? What instruments are you allowed to do and to what extent? And finally, we need also to clarify the distinction between permanent interventions and temporary ones. Thank you very much.
Thank you, Jean-Charles. Our second discussant is Philip Schnabel from NYU.
Yeah, well, thanks a lot for having me here. Thanks a lot for the organizers to ask me to discuss this very interesting paper. Let me give you a short summary in my own words of what the paper is doing. So the paper is really asking the question, how did the ECB interventions during COVID-19 affect bond mutual funds? And it's sort of focusing on two mechanisms. The first one is looking at asset purchase programs. They have a very direct effect on bond funds because potentially going to raise the price of assets held by those funds. And the second one is sort of an indirect channel in the sense that the ECB in various ways provided liquidity to banks, as is usual in a crisis. And banks can turn around and channel that liquidity to those funds via providing repos to bond funds. Now, from an empirical perspective, the paper has sort of two main results. So result number one is a figure you kind of have seen already. It's my favorite figure in the paper. It's a very nice idea. They sort of take funds which have a high share of central bank eligible assets and compare it with funds with a low share of central bank eligible assets. And you kind of see the ones that have a high share, that's the solid blue line here, they outperform the low eligibility funds. Now, it's important to note that they converge pretty quickly. They're back to sort of being on the same line within a few months, and that's coming from the fact that the low eligibility funds often hold US securities, and the US security facilities were announced a bit later. But the sort of the ECB announcement effect, I think, is well identified here. And then the second result, and I would have liked to present the figure, it's kind of missing in the paper. This is sort of the table which speaks to it, is the idea that when the ECB provided liquidity to banks, it helped funds who did have a pre-existing relationship with their bank, which took out significant borrowing under the LTRO. So funds which have this relationship with an LTRO bank do receive more repo funding. So those are the kind of two main results. And the main takeaway is basically that the bond funds benefited in some sense directly and indirectly from ECB interventions, sort of this underlying tone that the answer to sort of the question posed in the title of the paper is no, we don't need other facilities. The ones we have are enough. So my assessment is this is a very interesting paper, an important question. Paper is wonderful data. It's clear that a lot of work already went into it, and the empirical analysis is carefully done. And I think it's kind of like really important for understanding, central bank interventions during past crises, and obviously given the topic of this conference, future crises. Now, since I only have a few minutes, I decided to focus on one comment. And I think that's something they could do in the paper and they should do in the paper. They have to tell us more of how important are these two channels. Now, if I had time for a second comment, it would be very close to what Jean-Charles was talking about. I'm not quite sure whether we can say that they don't need access to the lender of last resort. I would have said slightly differently. In some sense, they already have access to the lender of last resort. And so I think there's a bigger question of why you want to intervene in those situations. Because clearly bond funds are benefiting of that, and then knowing that that will be the case, you would think it could be priced into securities, it's going to affect the liquidity. So the typical question about moral hazard will come up. And in fairness, you have a sort of section at the end which talks about that. And it sort of goes beyond the paper, but I think that's the other main thing to sort of think about. But in terms of the paper, let me give you my assessment on how I understand it from the paper on how important these things are. So what about the empirical identification? So as I mentioned before, we're just comparing funds depending on the share of central bank eligible assets. Now, just knowing that strategy, I would have been sort of concerned that maybe there could be differences in risk exposures. These funds could be very different. That's why they're performing differently. I'll bring up my favorite figure again. As Marie pointed out, this is very convincing. You see sort of the performance to being on top of each other until the announcement. When the announcement happens, they start to diverge exactly at the announcement. So I think the identification here is actually pretty clean. I would say it's also consistent with the work from the US. So there's a very nice paper which has now been published in the AR by Haddad, Moreira, and Maria, and they sort of look at what they call conditional policy promises. And the way I think about the mechanism in this paper is maybe similar in the US. They argued that these policy puts, so the idea that when you make the announcement, you're effectively committing yourself as a central bank to purchase assets when things get really worse, these policy puts explains a large share of the price impact. Now in the US, you didn't actually have to go out and buy much, the Fed almost nothing, but it does mean that there's a commitment of, you might end up making these large purchases, so you're potentially taking on significant risks. So I think sort of connecting it a bit more with that mechanism, I think would be useful. Now in terms of magnitude, just sort of back of the envelope, the funds which had eligible assets, there were 46% of assets were eligible versus just 5% the others. And in the regressions, they estimate sort of a differential effect on the performance, 3.6%. So back of the envelope that suggests when assets became eligible, basically it increased the value of the asset by roughly 8.8%, almost 9%. So I would consider that large. That's pretty significant. Now compare that with the repo funding. So what's the idea between the repo funding? So here, you're going to compare funds effectively depending on their pre-existing, pre-COVID relationships. Now, there is sort of a well-established methodology in banking of doing that. The concern you do when you do that is always that, you're going to think about the relationships you're going to have down the line. If there's a crisis and you think you're going to have a lot of demand for funding, well, you probably want to sort of bank with those banks who are going to provide that. So in that setting, potentially that sort of proxy could really sort of signify that there's demand for loans, demand for repos. It's not the supply, as the paper wants to make it out. Now, what the authors are doing is sort of the quasi-Meehan methodology, looking within the fund across bank relationships. I think that part is actually very convincing. Now, you need a strong identification assumption when you aggregate up to the fund, but I think that's actually fine in this setting. Now, one issue I have, and you have seen this figure before, this is sort of total new repo lending to these bond funds. And in aggregate, I think it's hard to make that case that this really matters. So if anything, it looks like that relative to sort of the pre-COVID period, the repo funding to these bond funds dropped. Now, presumably without bank liquidity support, it might have dropped even more, but it wasn't that large to begin with, and it actually got smaller. It sort of piped up after the bridge LTROs, but it's still less than before. So there's a bit of sort of a missing intercept problem, thinking about the aggregate effect. So some of it may just be sort of redistributing sort of funds towards banks who happen to have these relationships. Now, if you look at the economic magnitude, sort of separate from the identification, I think there's also sort of a bit of an issue. I couldn't quite find in the paper, but my understanding from looking sort of aggregate numbers is, and I think Marie mentioned those in the presentation, is relatively small. It's something on the order of 3% of total fund assets pre-COVID, and only sort of a limited number of funds actually borrow in the repo market. And there's actually a limit, and I think Marie mentioned as well, they mentioned in the paper, you can never borrow more than 10%. And the regressions, at least as far as I understand them, having a better relationship increases repo funding by a relatively small amount, 26 basis points. There's a large effect on fund performance, but I think timing of that is not quite clear because I think it should come at the announcement, given I think that this information is known, but it only comes actually when it's being implemented, so I wasn't quite sure how to interpret that. Now, basically what that means, or the way I read it, is the asset purchases had a really economically large effect. And as I mentioned before, I think we really want to understand better whether that's the right thing to do, what's the potential moral hazard associated with that. I think the repo funding was sort of second order. Now, I don't think that's a problem for the paper at all. I think it's just as important to know what works relative to what doesn't work. So in some sense, I would just like to know what's the author's stance. If they agree, well, then maybe sort of, make that clear that it doesn't work, or, if I'm wrong, then maybe make it clear on why it would be important. Now, one important thing is, if you had asked me before reading the paper of what's going to be the impact of ECB banking liquidity, I wouldn't have thought about repos. I would have thought about, well, in crisis, we know that bank balance sheets typically blow up. Why? Because too big to fail bank's going to get deposits, and they have access to the lender of last resort. So what do? They go out and often purchase assets. So I would have thought that would be sort of the first order effect. Now, they actually look at this as a footnote, and they say we don't have perfect data. But I think that's actually very useful. They think that's not the case. So maybe a little bit more analysis on that would be helpful. But I think that would be the other channel you may have in mind. So with that, let me conclude. I think it's a very interesting paper. I think the asset purchases are clearly first order. We understand those better. Repo funding, to me at least, in second order. I would like them to quantify it more. I think this paper is highly recommended for anybody interested in understanding central bank interventions. Thank you.
Thanks, Philip. Let's open up for Q&A, and Marie, you can then, while you're answering questions, maybe also address what the discussants raised. So I got to remind the participants to stand up and ask the questions using the microphone. If there are no questions, oh, there is, okay. Could we have a microphone here?
So Pierre-Olivier Gouranchat from the IMF. Thought the paper was very interesting. On the first part, on the asset purchase, there is a part that is kind of mechanical, right? The ECB is announcing that it's going to purchase asset A, fund 1 as assets A in its balance sheet. Everyone expects asset A's price to go up. The fund performance is going to be higher than fund number 2, which doesn't have asset A. But then there's part of me that's thinking, you're measuring only a different effect. And so I'd like to see the fund flows. You're not showing us the fund flows. Do I see that there is less outflows from fund 1 relative to fund 2? It could be that just I look at fund 2 and I see it doesn't have assets that are purchased by the ECB. I want to move out, and the performance of that fund goes in a tank. The other one does better, but it's all relative, and they're still doing pretty poorly. So I think there's the intercept effect, and I'd like to see the fund flows as well. On the second, the provision of liquidity through the banks, I'm with Philip here that it seems very indirect. If we want to rely on this to provide support to the funds, there are all kinds of reasons it could not work. You could imagine that the banks are not going to be channeling the liquidity they get from the TLTRO to the funds. Maybe they will buy sovereign bonds. And there are earlier episodes of liquidity provision where that is exactly what happened, and you would be concerned about whether the liquidity ends up in the right place. So it leaves me in a little bit of an uncomfortable position in concluding with you, oh, we have the right instruments, it's all fine. At the same time, I think that I'm also uncomfortable if I think that we have to do more, if central banks have to do more for non-bank financial institutions. So, thanks.
No, thanks so much, Pierre-Olivier, and many thanks to Jean-Charles and Philippe for a really fantastic discussion. So let me maybe start with Pierre-Olivier, but it touches upon some of the things that also Jean-Charles and Philippe brought up. So on the flows, that's actually the variable we care about, right? Because I motivated everything with runs, and we really care whether somehow what the central banks did manage to actually stop the run, right? And I showed it not in the form of this very nice figure, although I think we can also produce a nice figure on that. I showed it in the form of a table, our result. So what I showed is with PEP announcement, there were continuous outflows in the group of funds that had lower PEP eligible assets, daily outflows on average of minus 0.5% of TNA. So these are very high outflows. You think in 2 days it's 1% of your TNA. In a week it's 2.5%. So it's very large outflows. And we show that the group of funds that had more PEP eligible assets only had outflows of minus 0.2%. So that's the differential of 0.3 percentage points that we showed. So that's, I would say, a large difference. Also, if you take minus 0.5 as the base and you take 0.2 as the outflow, it's 63% increase in net flows. That's a very large effect, I would argue, on the flows. So, and again, it's maybe not terribly surprising once PEP improved performance, which you say, arguably is mechanical for those that have a lot of PEP eligible assets. This is what we would expect. The flows should also improve, right? We know that bad performance triggers outflows. Here, performance improved, outflows should also improve. And we do see that, and quite strongly. So this would be my take on this. On the bank channel, so actually going into this, it was, I think our prior was similar to yours, which is to say, okay, we know banks have access to lender of last resort. Of course, in the world without frictions, they might pass on this liquidity to the rest of the financial system, but we do not live in the world without frictions, right? And we know that there are many reasons why banks might not pass on that liquidity. I mean, there was work done also by Johannes and Victoria on leverage ratio and so on. So now we argue with the repo lending. Maybe leverage ratio is a bit less binding because repo lending doesn't really increase your leverage. Repo borrowing does. But to the extent that banks want to run a matched repo book, maybe that also factors in. So there are lots of market power, lots of frictions that might prevent a smooth passing on of central bank liquidity to other parts of the financial system. This was our prior, and we wanted to see what happens in the data. To our surprise, we actually did see that this, if you will, bank lending channel of channeling central bank liquidity to non-banks is there. Now, that brings me to Philippe's point. Is it large and can we fully rely on it? To be frank, it is not large, it seems to us. And for me, the two key points, it's not that it is not so large in terms of what banks pass on. Actually, I think our coefficients are reasonably large. But it's more the extent to which funds use this market. They use it very little. I don't have an answer why that is the case, but they do not rely heavily on repo borrowing in the euro area. I do not know the data in other jurisdictions. So, kind of coming back to, I think Nicola mentioned this morning, sort of liquidity insurance, right? So one way to think about this bank repo lending to funds is like, this is their lifeline to the lender of last resort, right? The indirect lender of last resort access. And, do many funds have this line? Not in the repo market. About 5% of bond funds, we estimate, have this line, but others not. Plus, there is this limit on leverage that we already mentioned. And was it binding? I mean, we find that I think about a quarter of our funds actually faced outflows of more than 10%. So they would hit that leverage limit quite quickly in this very severe crisis. Maybe I'll come back to one of the points of Jean-Charles, which is to say, what kind of intervention was it? What drove? What was the underlying friction? What was the purpose? I mean, to me, the purpose was clear, was to respond to a turmoil triggered by an exogenous event, a pandemic. This was an aggregate liquidity shock. This is a circumstance where central banks should intervene. It's the only agent in the economy that is not subject to liquidity constraints. Now, I think the ECB was clear that the PEP in particular had a dual role. One was the market stabilization role, and that is very clearly what we have focused on in the paper. But there was also this other role, which is to deliver monetary accommodation in the zero lower bound, and this was basically for price stability. We haven't looked at this in this paper, so I want to stay away from that. But there is, of course, I think one important aspect, and this touches also on Raghu's keynote. To me, mopping up after every crisis in an ad hoc way does create the expectations that central bank is always there. And I think it does raise moral hazard concerns. So to me, a useful distinction is between discretionary ex post interventions and more rule-based arrangements. And if I think about asset purchases in response to exogenous aggregate liquidity shock, pandemic, 9/11, terrible events, and the central bank has a predefined list of eligible assets it buys, if anything, the funds should be thinking, okay, I want to get that liquidity insurance from the market maker of last resort in the case of an aggregate liquidity crisis. I should hold these type of assets. And those are liquid assets in normal times, kind of in line with the Bagehot's principle. And so to me, the specter of moral hazard is highly diminished here. Because if anything, we're encouraging them to hold more liquid assets rather than the moral hazard I typically think about is loading up on illiquid, very risky assets. Okay? Because we clearly showed that it was the funds that actually do have those highly liquid in normal times assets that benefited from the PEP.
Well, thanks, Alessio De Vincenzo, Banca d'Italia. Thanks a lot for the presentation. Just following up on your last point on the risk exposures, I was wondering whether you had the possibility to check, let's say, or to verify whether there's a difference between the two types of funds exposed in their risk exposures attitude. I'm just mentioning this because there is work done at the bank by a couple of colleagues, actually, that found that both for European funds and US funds that had exposures to assets, part of the eligible assets under the PEP program, and they actually found that in their risk exposure or risk-taking attitude, there was a difference. So the ones that were exposed, the higher share of liquid assets, actually, their composition of the portfolio changed a little bit after this intervention, maybe over an horizon that is longer than the horizons that you have taken into account. But in a way, the risk attitude changed a little bit, increased with respect to the other category of funds. So I guess, whether this might be useful also in terms of the overall debate, whether or not this support that this indirectly obtained from this intervention has to be somehow part of a discussion of a reform or a review of the regulation on these funds. Thanks.
No, thanks a lot. We haven't looked at it explicitly on the ex post performance. We could. And indeed, it's an interesting question. Again, if investors value that liquidity insurance from the market maker of last resort, if anything, one would expect that funds might want to invest more in this type of assets, ceteris paribus. So, but this is something that we can investigate if there is actually some realization on the part of the funds that this is actually a valuable liquidity insurance. Of course, presumably these assets have a lower yield in normal times, so there is a trade-off. But that's what insurance is about.
Thank you. Enrico Perotti, University of Amsterdam, still the same. So I worked on bank runs, and I think I'm particularly interested in the question of what creates an escalation. So the March 2020 was a time where there was legitimate demand for liquidity, which pulled a lot of money out of funds, even more in the US. That was completely legitimate. And then there was, of course, escalation potentially, and certainly, interestingly, bond funds are the one where you have a bank run type of concern that if everyone is running on your fund, and these are illiquid assets, like banks, not like money market fund, even stock funds are not as illiquid, that you want to be out quickly. So what I think would be very interesting is to try to separate the direct impact and the indirect impact. I mean, what I find striking is that the impact you see is there even before you start to have purchases. So it's the announcement effect. So the key, if we want to contain outflows from funds that are self-fulfilling, is to discourage the process of escalation where people that need liquidity get it, and everyone else doesn't start to think, what is everyone else going to do? And in the US, since 2023, there are, for specific institutional funds, mandatory charges, redemption charges, which are triggered automatically upon very large outflows. And that's exactly the kind of sand in the wheel that stops the self-fulfilling component. There is a similar legislation proposed in Europe. I'm not sure if it applies to bond funds. But, okay, aside from this aside, I have a sense that you have measurement or quantity both, and you can actually separate how much is the announcement effect, the quantity effect, and I think that would be interesting. Thank you.
No, thanks a lot, Enrico, for this question. So, I mean, you're right. The old-style runs in the fund sector. I mean, Itai Goldstein has written on this already. I think in 2010, right? I think the president alluded to it in her speech, right? There are always the same ingredients that lead to runs, right? It's liquidity, it's fire sales, it's multiplicity of equilibria, right? Which is sort of the ingredients that feed into the fragility in funds, or in bond funds in particular, and sort of there are these front-running incentives, and it is linked to the liquidity of assets, the fire sales, but also the fact that the fund promises a fixed value to the investor, which is the value of the fund at the end of the day, whereas liquidation actually typically takes several days. So those who get out early get out at a better price, and so this creates these front-running incentives. Now, you mentioned something very important, which is that, shouldn't we also, I mean, the way I interpret your question is that shouldn't we also think about what leads to runs and tackle those issues? And so there are proposals indeed of swing pricing, which would tackle something like this. Let me just mention maybe two things in the European context. Swing pricing was actually allowed in Europe already before COVID. What is interesting, it was in the discretion of the fund whether to impose it or not, and funds actually chose, by and large, not to impose it. And I think there is an interesting coordination problem there, and perhaps it should be imposed by somebody else just than the fund itself. You also mentioned there were large outflows in the US, even larger than in Europe. I would put it a bit differently. In absolute terms, in euros or dollars, the outflows were actually very similar in both Europe and the US. But the fund sector in Europe is actually quite a bit smaller. So in relative terms, there were a huge run in Europe, enormous. And we have looked in another work on actually who was withdrawing money from the European funds. We looked at the liability side, and what we did is we even looked within the same fund and day, so holding the asset side fixed. So you talked about risk, but here we're holding the risk and liquidity, everything constant. And so what we found is it was not households who were running on funds, but actually a particular segment of institutional investors, and often also entities outside the euro area. So there was if you will, fragility in funds is linked to this liquidity provision. And I think the point is, whom is this liquidity provided to? Is it households or is it somebody else? We find that it is often somebody else. And there is some free riding on this liquidity provision by foreign investors and sophisticated investors. And I think that's something very, very worthy thinking about how we deal with these issues. Thank you.
One last question.
So Paola Sapienza, Hoover Institution. Following up on this and what Pierre-Olivier said before, there are costs of this. I mean, I understand that you're comparing, a more draconian intervention to the least draconian, and you say this is enough. So, that could be. But there are really big costs in running these, which doesn't seem to appear in the presentation. And, some of this is distributional, which is what you're touching upon. So to what extent this was needed in the first place. You say, well, there is an effect. A part of the effect is mechanical, but also, and of course, the counterfactual, I think this is an unfair question in some way because we don't know the counterfactual, we don't know what would have happened and so on. But I'm wondering if there is a way you're thinking about, evaluating the cost of intervening at all, because there is, and this goes back also to, one of the discussants, just what's the objective here? Who are we sheltering from? And, the fact that you mentioned that there are distributional factor just enhances my interest in this question.
Again, excellent question. So I think this calls for a good model. Also so that we can understand normative implications and compare policies and so on and so forth. Here we took I think a very pragmatic approach, meaning we said, look, even the most liquid markets, treasury markets, bond markets in Europe are in turmoil. There is no way the central bank is not going to intervene. It's just inconsistent to say anything else, and it did. And let's see whether in these interventions, as well as these indirect interventions in terms of providing liquidity to banks, does it trickle down to non-banks that have no lender of last resort access, right? And we just wanted to trace these channels. But I think the broader question of the relative importance of interventions, this is also the point that Philip brought in, and the costs and benefits. I mean, we mostly looked here at the benefits and some of the caveats to the propagation mechanism, like the repos are not widely used, et cetera. But I think you're spot on. We have not really explicitly considered what are the costs of different intervention. And so in a full-fledged analysis of, should there be access, should not be access, this should definitely feature. This is not a normative paper. This is just to say, you know what? We are hearing also from our operational colleagues, it's very hard to think how to set up the framework of giving access to this extremely heterogeneous and a huge NBFI sector. Let's take a first step. We have tools. Do they actually have a way to reach the non-banks? And the answer is yes. And when it comes to purchases, it reaches them quickly and stops runs very fast.
All right. Thank you, Marie. Thank you, Jean-Charles. Thank you, Philip. We now have a coffee break. We are back at 3:30. So thank you, speakers.
Okay, so we're going to get started with the next session on banks, shifting from non-banks to banks. And we'll follow the same procedures. When we get to the question and answer, please stand up and announce who you are, where your affiliation is. And I want to turn the floor over to Victoria Ivashina, who's going to tell us about bank runs and interest rates.
All right. Thank you so much, Ross, and thank you to organizers for including the paper. This is joint work with Falk Browning, who's at the Federal Bank of Boston. All right, so we already talked today about revolving lines runs, and it might be helpful for everybody to remember that revolving lines are very common in the economy. Most of the companies out there have a revolving line because it's primarily used for management of working capital. That's the reason why a company would run on a revolving line, because access to funding for their working capital is essential for operation of many companies. But we're going to talk about it from perspective of the bank balance sheet. And specifically, the question we're interested in is about runs on revolving lines. So here I'm plotting for you in red uninsured deposits. So those are runnable liabilities for the bank. And in blue are unused revolving lines. So revolving lines can be withdrawn at any given point in time. And the point here is, of course, to show you that, well, revolving line exposure is quite sizable on the balance sheet of the US banks. And we know also that from 2008 and 2020 when we faced a run. Now, what we want to highlight in this paper is that revolving lines are dependent, the runs on revolving lines are sensitive to interest rates. So we already knew that they are runnable. And interestingly enough, while they ran in 2008, they ran in 2020, they didn't run in 2023. And this is where our point comes in. The interest rates were high, and that was an effect that affected revolving lines. How exactly? Well, revolving lines are actually variable rate debt. And if you don't use a revolving line as a company, then you just pay a small fixed fee. If you use a revolving line, well, then it becomes like any other credit, and it's priced as a base rate. Nowadays, it's SOFR. Earlier in our sample, in our data, it will be LIBOR, but there is a base rate plus a fixed spread, and it's the base rate, that fluctuation in the base rate, that's what makes this a variable debt. And so deposit runs are independent on interest rates. Deposits are our assets. Whatever interest rate environment is, if I'm uncertain about the health of the bank, I will run on my deposits just to make sure that I get my money back. On revolving lines, if for a company, revolving line is a liability and they have to pay for it, and they pay the amount that they have to pay in interest rate will depend on the interest rate environment. Same idea, just to put a little bit of structure on it, to highlight for you what exactly are the key assumptions that go into all of this. Let's put aside the term loans. Term loans are credit issued for specific purpose, drawn at inception of the loan. When it's repaid, it's canceled. Revolving line is open until maturity. You can draw, repay as many times as you want. So assume that you have, we're going to put aside term loans, just focus on revolving lines. You get it at time 0, but investment comes around at time 1. And you have a continuous function for thinking about investments, and you're going to use your credit for investment. You're going to pay an interest rate on drawn amount. And for simplicity, let's assume that you don't pay anything if the line remains undrawn. Now, because if you draw precautionary, you have to actually park the cash somewhere. So we're gonna, in this case, let's say that you put it in deposits. You're gonna probably put it in deposits in some other institution, not the bank on which you are running, because you're concerned about the health of the bank. But so there is what you're gonna earn on that cash that you have to sit because you drew it, not because you had an investment, but because you had a precautionary motive. And the difference between this rate will be essential. Now with probability P, bank goes bust. And whatever you didn't draw, you don't get to invest. So now you're only going to be investing the amounts that you drew for precautionary reasons. That's the basic mechanism, that's the basic little structures that you need to arrive to the points that we're making. And so basically, unless you drew up front, there is with some probability, with probability 1 minus, with probability P, you don't get to invest anything else. And so that gives, and so you can articulate a function where you're trying to optimize with respect to how much you draw up front. And this leads you to a couple of consequences. Some of them are obvious. For example, you're more likely to draw on the line if the bank is more likely to go bust. That makes a lot of sense. The one that is more relevant to us is the one that I'm putting here on the slide, and it's the one that tells you that you are likely to draw for precautionary reasons as a function of the gap that exists between the rates and the probability of the bank going bust. So that's the effect that we're after. And, of course, that should have highlighted for you that this gap between the rates is very, very important. Now, we do a couple of things trying to think through this, but this graph should be helpful. In green, I'm showing you deposit rates, and blue and red, one is a policy rate, and the red is policy rate, and the blue is the interest rate on unused commitments. So you can see how this idea that what you're going to pay on your line tracks the policy rate, whereas what you're going to make on your deposits doesn't. And this idea, of course, been out for a while, and it's very easy to illustrate. So that's the origin of this gap. Now, if they would start, it's conceivable that fraction of the money goes into money market fund, and the statistic indicates that some fraction of the money withdrawn in 2023 went into money market funds that, of course, pay rates that are market rates. However, not everything went into money market funds, and so to the degree that brings the effect down, but it doesn't cancel the effect. As long as some part of the money returns to the banking system, and as importantly, as long as it continues earning the rates that is not connected directly to the rates that they are paying on the loan of which they are drawing, that effect will continue going through. All right, so we're going to use, this is paper, it's empirical, we're going to use the equivalent to the credit registry data. This is US data that comes from the stress testing. So the caveat is that it only covers larger banks. The clean data also starts in 2015. We can't quite regress, just take a time series and regress usage of lines on the interest rates, right? I mean, for starters, there is an obvious problem that interest rates are endogenous. We would need some sort of shocks. We would also need, our data starts in 2015. We also would need environments of low interest rates and high interest rate to test this idea. Moreover, since we are after a precautionary motive, we need context where precautionary motive is plausible. We cannot even just take an entire time series. So this entire thing is very, very hard to operationalize empirically in some intuitive and quick way. So we actually going to have what we think is a clever solution. It comes from a cross-section. And what we're going to be using is the so-called method of regression king design. And we're specifically going to focus on 2020 episode. All right. So what is special about 2020? So here in blue, you can see utilization of revolving lines. And you can see how 2020 is big outliers. There is one quarter that there is a big draw on revolving lines. But importantly, next quarter, it comes down. So this is reassuring to us that there was a precautionary motive in the error. Because if it would be for investment opportunities or anything else, this money would have not been repaid very quickly. It would have been drawn and it would have been sitting there. So this indicates to us that 2020 is a good moment. There is other research besides ours that also thinks about precautionary motive in 2020 and concludes that that's something that was important in 2020. All right. So as far as the methodologies that we're pursuing, the idea is the following. So most of you are familiar with regression discontinuity design, which is the first graph. And there it's typically just a switch. Something switches on your new regime, and that's what allows you to define an effect simply by plugging a dummy interacted with what you're measuring. So for example, in the context of credit, there is a large literature that measures consequences, contractual consequences of violation of covenants. So a violation of covenants is a discontinuity. It shifts control rights from equity to debt, and that allows us to detect economic effects of that. Regression king design is something that is identified from a slope. So there is a shift, but it's not a shift in levels, it's a shift in the way the slope operates. Obviously, I'm not gonna give you a lecture on regression king design here, but so where does it come from? And I hope this will make it very, very clear. So I skipped one detail when I introduced the interest rate. I said to you, it's a variable rate, it's a fixed spread over a base, right? Here I'm putting LIBOR. Well, in reality, after the financial crisis, it also includes floors, LIBOR floors, or SOFR floors at this point. Basically, the interest rate is the base rate, except that a contract will also include the floor. So it can never go below that floor, even if the policy rate continues going down, right? And so that creates a discontinuity where up to the floor, the rate is actually proportional. It's a variable rate. But then once you hit the floor, it's flat. It's a fixed rate. Now, the way it looks in the data, it's like this. I cannot follow the same company, right? Because if you think about, for the same company, the rates don't change that much, right? Because so there would be few observations. So this graph is generated from a cross-section, which is why it doesn't line up on one line. But you can see how this regression discontinuity is right there. You can see it perfectly. So the red line is the one that tells you where you are at the floor, and it's fixed before that, and it's variable proportional to the rate after that. Right, so we're going to use this variation, the fact that there is cross-sectional variation depending on the distance to the floors. Now, there is some commentary in the paper about distance to the floor, but technically, actually, because we are identifying out of this break, it is, unless you believe that everything else aligns, all the other fundamental variables align with this discontinuity in the cross-section, you are basically don't need to justify that the floors are somehow exogenous, right? And so that's the core of the methodology. Now, we're going to estimate, so what we do here is the following. So when you do level estimation, when you do regression discontinuity designs, then it's one equation with interaction terms. In this context, you just kind of have to construct your coefficient of interest. And so what I'm showing you here, there are 3 panels. I'm just being transparent. I could have reported you only the top one, but actually there are 3. The bottom 2 are the composition of the interest rate as well as utilization rate. And so those 2 are estimated separately, and then you construct the elasticity, which is what you're trying to estimate. The 3 columns correspond just to different controls, right? And so if, for example, we move from the first column to the last column, the effect varies between close to 13% to close to 8%. What this means is, so let's take the last column, that the estimate tells when the interest rate, policy interest rate, which translates to the interest rate that the companies pay on their loan, goes up by 1 percentage point, the probability of using a revolving line for precautionary reason goes down by 8 percentage points. So that's quite substantial, right? All right, so that's the main result. The only other thing that we do is, actually, if you think about it, what I provided you is a methodology for estimating elasticity of using a revolving line, period. I centered it around a period where there is precautionary motive, and I'm attributing it to precautionary motive, but actually, there is always some elasticity. And so what we did separately is we tried to sort companies based on those that where precautionary motive is much more clear than in another group. And then based on this separation, we are showing you here that actually there is an incremental effect for the group where we believe that the precautionary motive is much stronger. Specifically here, the column 2 and 4 identify companies that under different criteria are drawing and instantly repaying. So that's that kind of criteria that we use for precautionary motive. All right, so now I'm gonna, in a few minutes that I have left, I'm gonna use it to make a broader point. And specifically what we thought about is that, okay, if the revolving lines, if you think about liquidity management more broadly, of course, one question that was in everybody's mind, especially after 2023, is utilization of run-on deposits. So what we want to do here is combine this idea of runny deposits with likelihood that the revolving lines will be run on as well. We're going to do it in a cross-section. So this is at this point we are detaching ourselves from this very hands-on identification that I showed you for detecting elasticity. Hopefully I convinced you of that idea and we measured that it's economically significant. But we are shifting now into the cross-section. So what I'm going to do is that I'm going to use broad data because now I need a time series, I need cross-section of banks in the data that I was using up until now. There were only large banks. There are some trade-offs. I no longer can measure perfectly revolving lines, but now I have longer period, I have more banks, et cetera, et cetera. All right. So what we did is, I'm about to show you the last graph in this presentation, and this will relate us. We're going to be looking at the cross-section of the banks that relying on the sample, and we're going to look at the relationship of betas for deposits to betas on the revolving lines. Betas as sensitivity to interest rate. Importantly, the higher rate for deposits means runnier. So higher beta for deposits means runny deposits, right? And higher beta for revolving lines, it's lower drawdowns. So they wired in the opposite direction, but the graphs that we find looks like this. So the correlations that we find in the cross-section is that they are positively related. So you have banks who have sticky deposits. Those have revolving lines that are very sensitive, that are very insensitive to interest rates, meaning they will run regardless of the interest rate environment. And at the same time, you have banks that have runny deposits. Well, those seem to be dealing with a type of revolving credit that is very sensitive to interest rates, meaning when you're a high interest environment, the revolving line will not run. That means that they offset each other. There is an offsetting element that you observe in the cross-section. If you face runny deposits, it's likely that your revolving lines are sitting tight in the context of high interest rate environment. All right, so the conclusions here, well, first we highlight that the fact that thinking about management of liquidity in a more comprehensive way. Deposits are very important by all means, but revolving lines also constitute an important exposure for the banks. And the point that we're making is that unlike deposits, revolving lines and runs on revolving lines are actually dependent on which interest rate environment you find yourself in. Now that, in our view, has some consequences. Some of them relate to how we think. Maybe there is something we need to think about the way banks operate. For example, the graph that I showed you seems to imply that in a cross-section, banks that depend on the funding that is runny tend to make revolving lines that that will stay around in the context of high interest rates. This also might change the way we think about 2023 a little bit, because when deposits were running, given that we were in a high interest rate environment, that actually meant that the revolving line were not running in that context, and that is the case. And finally, one interesting point from here is that historically, typical policy response was to bring down the interest rate in response to a negative economic shock. And what a consequence of our paper is that when you do that, you precipitate a run on the revolving line. Thank you.
Thank you. And our first discussant is Emil Werner from MIT.
Okay, thank you so much for inviting me to this great conference to discuss this very interesting paper. So the paper is about credit lines. These are commitments to draw any amount of credit at pre-agreed pricing terms, limit, and maturity. And this is a segment where banks are still dominant, unlike many other forms of lending, as we saw earlier today. So the question the paper asks is, what is the interest sensitivity of credit line drawdowns, and how does this affect usage during a crisis, like, for example, March 2023? So the empirical setting is quite nice. It's this regression kink design utilizing these interest rate floors that basically lets you very credibly identify the elasticity of drawdowns with respect to interest rates. And the findings are that revolving line usage is interest sensitive, and it's especially sensitive actually during normal times. It's somewhat less sensitive during crisis times, but nevertheless sensitive across both episodes. And then taking a step back, across banks, there's this negative correlation between deposit outflows and credit line drawdowns, indicative of some sort of synergies between these two sources of the bank's business. And so the broader implication that the paper draws is that runs on credit lines as opposed to deposits are less likely when interest rates are high. So this is one of the figures that I like from the paper. This shows total committed credit lines for large US banks in the Y14 data. And you see, first of all, these are big numbers, $2 trillion in recent years. And it's also gone up quite a bit since the 2008 crisis related to some of the points that were made this morning. And then you see this big drawdown in Q1 of 2020. So in my discussion, I think this is a very nicely executed paper. I'm not going to kind of nitpick too much on the empirical analysis. I find it quite convincing. Instead, what I'm going to do is I'm going to try to think more generally about the drivers of credit line drawdowns and the history of these episodes. Then I'll think a little bit about why were there no drawdowns in 2020, and I'll think about interest rates and maybe push back and talk about some other factors. And then I'll briefly talk about some financial stability considerations. So if you think about why would a firm want to draw down its credit line, well, one natural reason is that it has some negative liquidity shock. This could be a financial shock, like there's a freeze in the commercial paper market, it can't roll over, so then it's going to have a credit line set up so that it can weather those types of shocks. It might be a real shock, like a cost shock or a temporary reduction in demand that means it's going to have less cash flow, and so it needs to kind of weather that. And so credit lines here are very valuable. They're mitigating the fall in investment. And we know that this is especially done by larger firms. So in the cross-section of firms, it's mostly big firms that are doing this. A second possibility is that there's a negative shock to bank solvency. And so firms with credit lines might get concerned and draw down precautionarily because they think, well, there's a macro shock, banks are in trouble. I might need that liquidity as well, so let me just kind of try to get ahead of things and get some of this cash now. And then the third possibility is, well, you could have a run or some sort of coordination failure where there's fear because of the fear of others, and you draw down even though you don't necessarily need the liquidity, but just because you want to make sure that you get ahead of others. And so this paper is saying that drawdowns are quantitatively dampened in each of these channels when the interest rate spread, and I'll get back to that point, is high. So then if you think about the supply side, the provision of credit lines, what really matters for the banks is basically what funding conditions are like for the banks when firms are drawing down, right? So what the covariance structure is between the drawdowns and funding conditions. And by funding conditions, I mean basically the cost of deposits and other sources of funding like wholesale funding. So kind of the more benign scenario is if there's a deposit inflow, right? So if, when firms are drawing down, the bank is getting deposits maybe from other sources, then this is really where banks actually have this comparative advantage. These are sort of offsetting each other. There still can be some issues for the bank because its balance sheet is going to expand, and so it might be capital constrained, and that might encumber some new lending, but sort of this is still a relatively benign scenario. The more problematic scenario for the bank is if funding conditions are tightening at the same time. If, for example, there's a deposit outflow because there's solvency concerns and that's raising the cost of wholesale funding and it's reducing large deposits that the bank has, then all of a sudden it's going to have to fund this drawdown with more expensive marginal sources of funding. So that could be borrowing from the interbank market, but in the US it's also very heavily borrowing from the FHLB or ultimately from the discount window. And this is going to be sort of a channel that's going to exacerbate problems for the bank in a crisis. So I tried to sort of take a step back and think about the major drawdown episodes in history, and I was hoping I could just find sort of a Reinhard Rogoff style paper that had this table. I couldn't, so I tried to make my own version. It seems to me one of the first major credit line drawdowns was the failure of Penn Central in 1970, where there's basically a freeze in the commercial paper market, and banks turn to their credit lines, they draw them down, and at the same time banks go to the discount window at the Fed to make sure they can cover that liquidity. At the same time, they're getting these deposit inflows. So the deposits are flowing in. This is sort of a relatively benign situation from the perspective of liquidity provision. The 1987 crash has some of that flavor as well. Russia's default LTCM, similar in that there's stress in capital markets, and so firms are turning to banks to smooth this liquidity shock. 9/11 as well to some extent. And the GFC is really where things are different, where there's basically both concerns about bank health and there's issues in capital markets. And so the banks that are experiencing these big drawdowns, they're also the ones that are actually not getting deposit inflows, and their funding is getting more expensive, so they're getting squeezed on both sides. And that's kind of the really problematic scenario. COVID, you had these massive drawdowns in quantity terms, but they were often precautionary. Firms left the funds within the banking system. Deposits actually go up at the same time. So while there were some problems, capital constraints become more binding, it's not it's not sort of the same type of crisis as 2008, which is sort of the most severe type of episode. And here's just some figures where you kind of see commercial paper, securities markets contracting and credit lines rising at the same time across these different episodes. And so I think the lesson is that the origin of the drawdown really matters. So for example, if it's a firm demand shock, either because there's some problems in securities markets or some cash flow shock, then credit lines are really valuable, right? They're a very useful stabilizer. On the other hand, if there's a shock to bank health, then the credit lines are going to amplify this shock because uninsured depositors are simultaneously going to flow out. And so then, bank is going to be squeezed from both sides. The other thing, if you look at sort of all of these episodes and you read about them, the government backstop really plays a key role. And Nicola was alluding to this morning. This is both from the lender of second last resort, the FHLB, and the lender of last resort. And I think this helps understand a lot why banks still are dominant in this market and are actually expanding in this market. So that brings me to this question of, well, why no drawdowns in 2023? And so the paper talks a lot about high interest rates. And I think the key consideration to have in mind is from the perspective of the firm, if you're going to draw down, well, you're going to pay the credit spread, and then you're going to deposit the funds, say, with a bank or with another bank or maybe in treasuries. And so there's going to be some spread. Here I call it the deposit spread. And the idea in the paper is that the derivative of this carry with respect to the policy rate is negative because the credit spread is going to move, 1 for 1, roughly 1 for 1 with the interest rate, but the deposit spread isn't. So we know, though, in the data that deposit rates for NFCs still have beta is less than 1, but they're higher than for households. I think they're higher than, for example, the picture that you showed. And corporate deposit in the US, there's some evidence from Cooperman et al. That they play close to the safe rate. So this delta carry to the interest rate, it might not always be so far away from zero, though kind of I grant that it is likely to be negative. But it does make me think, are there maybe other stories? Because if you look at these historical episodes, like for example, LTCM, the Fed funds rate was above 5%, and there were substantial drawdowns at this time. And so that made me think, well, maybe 2023 is different for other reasons too. Maybe there is just a more limited demand shock for liquidity. Capital markets aren't frozen. Firms aren't experiencing big declines in their sales. There aren't concerns about the health of major banks, at least the ones in your data set, right? The runs that we saw were concentrated in these more regional banks. And there was also this strong policy response at the same time that allayed concerns about kind of banking sector solvency. So my suggestions here would be to provide some more evidence on the deposit rates that different types of corporate borrowers that use credit lines are likely to receive and how those change with interest rates. Then look at the credit lines of the regional banks that are actually subject to funding stress. I know they're not in the Y14 data necessarily, but you can still get a picture of them through the call reports. And then maybe do some kind of mini calibration where you think about your estimated elasticity in sort of a stress scenario and think about, well, how much could this interest rate spread effect offset kind of a general large-scale demand for liquidity. And then finally, let me just say a few things about financial stability implications going forward. So as I kind of alluded to, there's these two perspectives. One, credit lines are really this valuable stabilizer. But on the other hand, they can be an amplifier of risk for banks. And it seems to me that, if you look at these past episodes, the key issues arise when the credit line drawdowns coincide with, solvency crises and fundamental issues for the banks that are exposed to these drawdowns. So we should see kind of the times of risk from credit line drawdowns as being an amplifier of sort of fundamental solvency risk, which I think is the main source of risk we should be concerned with anyway. And one other, I think, just interesting implication of your paper is, in the US, there's been a lot of discussion of this transition from LIBOR, which is a credit risk sensitive measure, to SOFR, which is risk-free. And so, for example, in the 2008 crisis, LIBOR actually increased a bit relative to the policy rate. And your paper is basically showing that because these drawdowns are interest sensitive, these drawdowns that we would see sort of in the next crisis, if risk-free rates come down because they're linked to SOFR, might actually make things even worse. And so that's kind of an implication of this interest rate sensitivity. So thank you very much.
And our next discussant is Jose Manuel Campa, and thank you.
Thank you. Thank you very much. Good afternoon, everybody. Thank you particularly for the organizers, or to the organizers for inviting me. It's really flattering that you still consider somebody like me to be up to discuss a paper in a research conference, so I'm very flattered by that. And I'm a little bit overwhelmed, but flattered. Anyway, I enjoy very much reading the paper. This is a very, very nice paper. I think it has a very good effort on calculating the elasticity of withdrawal from pre-committed lines to interest rates. I think this is a very obviously relevant topic. I'll make a few comments that this is not a relevant topic just for the US. It's very important also for the EU. In fact, the prevalence of these instruments in the European Union banking sector is just as big as in the US, if not bigger. So I'll make 3 comments on 3 areas. First, I'll make a few comments on the model itself and the estimation strategy, and then I'll make a broader relevance to the topic of the EU, as I mentioned before, and then implications for bank runs and financial stability as the paper does a little bit as well. So let's talk on the model and the estimation strategy. At the end, the model, which is a Mickey Mouse model, a simple model, but very illustrative, shows that the reasons for early withdrawal are fundamentally 3. One is the attractiveness of a project that the firm may have to be investing in, and having that liquidity to do that investment is there. Second one is the difference between the price of the committed line and the alternative liquid investment that they can put that liquidity in, and that's the key variable, and the interest rate elasticity that we're trying to estimate. And the third one is the probability of default of the bank. Okay. Now, as I said, the relevant price here to me and in the equations is the difference between the price of the committed line and the alternative liquid investment. In the model, there's no alternative source of funding. The firm cannot go and raise fundings for this investment somewhere else, which should be also a relevant opportunity cost, more broadly speaking, in general. Now, the firm, when it holds the cash, for precautionary motives, we know it has alternatives. It can put it in a deposit, it can put it in a mutual market fund, it can put it in the same bank, it can put it in different banks. So here, this is simplified by taking the deposit rate, but I think this is crucial to understand well the empirical strategy and the empirical tests, because to me, the empirical strategy, by the way, thank you very much for letting me read the paper. I have no idea what this arcade technique is. I'm not sure I know yet, but at least I know about it, and it's really good. I've made a lot of progress, personal progress. So, but the relevance for the identification here is this kink on the interest rate, and the fact that there's this floor on the interest rate, and they show this nice picture in which there is this floor, this kink and this floor, but they show that picture on the interest rate that the company has to pay on the withdrawal amounts. They don't show that kink, and to me it's not clear that that kink exists on the real, what I consider to be the real price, which is the difference between that rate and the rate at which the firm will reinvest that money. Particularly to me, given, I'll give you the simple example, you mentioned, Emil, that there's positive betas for corporate deposits, so basically the corporate deposits don't get paid at zero, but we do know there's a large amount of downward rigidity beyond zero. So it's likely to be that the alternative cost in that pay is clearly kinking around zero. For money market funds, the same thing. I can put in a money market fund if it pays me positive. If it pays me negative, I just put it in a deposit. So it's likely that that alternative also has exactly the same kink at exactly the same place. So when I think about the difference, which is the relevant, I'm not sure that the kink is there. And that's a thing I think that we need to, I would like to be more convinced on that part, Coming back to the relevance of this for the EU economy, I'll just brought some statistics, since this is what we do at the ABA, we collect data. And we write regulation too, but we do collect data. But here what you see is basically, I tried to reproduce the chart that was shown by both Victoria and also by Emil. What you have in the left-hand side, the ratio of loan commitments to share of liabilities. In Europe, is in the range approximately over this period of about 17 to 18%. The chart in the US shows about 16%, so it's basically in the same range of amounts. On the right-hand side is basically the sum of all off-balance sheet commitments of the banks, which is, loan commitments plus financial guarantees plus other commitments. It's a bit larger, now obviously, because it includes loan commitments but other starts, but the core of that part is really loan commitments, so that's very large. Now here, what you have is something that I think is important, is also the reaction of this, of the behavior, the change in the behavior of these off-balance sheet items through these episodes. It starts with COVID at the beginning of 2020, the second quarter right after the COVID, how the banks react, and it goes up to the end of 2022 for Europe relevant because that's basically the Russian invasion of the Ukraine. Well, you see there is tremendous policy action around COVID. Supply chain, this is not withdrawals, this is commitments by banks. And what you see, the orange one is the loan commitment. So it's been a huge increase in the second quarter of 2020, by the banks, proactively providing commitments, part of the policy action, because there was a lot of liquidity being provided in that country to try to react to COVID. So I think that that's something that I also am not sure is the same. I assume it's the same in the US. I don't have the figures, but I'm pretty sure because the policy action was essentially the same. So I'm not sure that this is properly captured in the paper. There's this big supply shock at the same time when you're trying to estimate this elasticity. Beyond that, when I think about the COVID episode, the paper uses the data from 2015 to 2022. Does not include the 2023 turmoil. And to me, that's a bit of a paradox, because intuitively, I would think that that's the best episode to try to estimate this, because COVID was an aggregate shock, not a banking-specific shock. It was a shock in which, from my perspective, the other variable, which is the investment opportunities that the firm has, is likely to have changed drastically. There are huge, though at the time, from our perspective, there were huge operational challenges on execution. There were huge demands for liquidity on precautionary basis. That's a good basis. But there were also huge uncertainties about the opportunity cost of the firms. So here, the cross-section, I think, can help you a lot in trying to identify that better, because to me, again, that opportunity cost of the firm in future investments is likely not to be linear as well. It's likely to potentially have kinks. So therefore, I'm not sure that the identification strategy is well. In fact, when you look at the results and you look at the evidence that you show, once you account for industry fixed effects, not just time fixed effects, but industry fixed effects, the overall effect and the economic significance of the elasticity drops a lot, which to me signals that there's a lot going on there in the cross-sectoral that has much more to do with volatility of the aspects. if I were now to talk a little bit about financial stability, and this is very, very quickly because I only have 2 minutes, but basically what you have here, what you have there on the left-hand side is the first chart I showed before, is the percentage of loan commitments, undrawn loan commitments. In the EU, unfortunately, we don't have evidence, card data on drawn loan commitments. We have undrawn and the change in undrawn loan commitments, which is a change obviously in drawn and change in supply. So it's a mix. But there you see the variability over time in 2020 and 2023. On the right-hand side, what you have is the behavior of demand deposits, very, very flat. So that correlation between loan commitments and demand deposits is not clear that it's there, at least at the first look like this. I will be a bit careful about making that assumption or making that relationship very, very good. Now, so what's the implication for financial stability? I must say I was a bit, maybe I'm too sensitive being at the EBA, but the first words in the title of the paper are bank runs, which is like, if you watch the movie Inside Out, it's only brings all your readings up. Then reading the paper, I'm much more happy because I don't see bank runs anywhere, so it's a relief. But I wonder, is there a run? What's the relationship? What's it putting here really the bank at stress? And that's the part where I think the paper is not clear, and the link is not clear, and I think Emil made that point already very much. It very much depends on what's the correlation between the withdrawals and the evolution of liquidity of the banks. I'll give you an example. I didn't put it here, but we published it in 2023. The contribution of the change in loan commitments and withdrawals in 2020 around COVID to the liquidity coverage ratio of the banks in the European Union was minor, was tiny. That contribution, basically the coverage ratio to affect, because there was huge policy action happening again at the same time. So I will be very careful about that. About where is the liquidity crunch, where is the correlation between those bank runs and those withdrawals of credit lines at the potential bank run of the financial instability concerns. The abstract says that sudden widespread drawdowns on credit lines can be destabilizing for the banking sector. It could be, but the paper is really about the price elasticity. It's not about this. So let's be careful there. One last point. There is no evidence also of flight to quality, which I would expect that will happen. If I'm withdrawing from a bank for a precautionary reason, because particularly there is a PIA probability of default, I would expect that I will invest the money in some kind of flight to quality. In 2020, there's no evidence. It's not really tested. I don't know. Maybe there was. But to me, intuitively, and this will be a key issue, I will encourage the authors to span the sample to 2023. Because the 2023 episode, I think there is, as you said already, first of all, you make conclusions about high interest rates. Well, let's see how sensitive they are to those high interest rates. Second, we know there was deposit shifts. We know there were deposit shifts across the US banks to large banks. There was a little bit of flight to quality. It'll be nice to see if that's really is also happening on these credit commitments, if that's evolving over time or not. So let me stop here because I'm out of time. Conclusion, thank you very much for letting me read the paper. It's a very good paper to read. It's a good effort on measuring this interest rate elasticity of precautionary withdrawals, but with more concern about on the paper on conclusions on uninsured versus insured deposits, bank runs, and financial stability concerns. Thanks a lot.
So I think we'll continue with the scenario of taking questions. You can obviously, in answering questions, choose to address some of the remarks by the discussants. And remember, please, to stand up and give your name and affiliation. Please, Kelly. Yes.
Kelly Hsu, Yale. So I found your interest rate channel actually quite intuitive and believable. My suggestion is, in your analysis, to add an additional control variable for a potential complementary explanation, which is, from the corporate perspective, the main alternative to these credit lines is obviously commercial paper. And so the health of the commercial paper market as well as the rates in that market really matter. If we compare 2020 and 2023, in 2020, the commercial paper market was just kind of inaccessible. So these firms had to draw on these credit lines. Whereas in 2023, even if you are kind of worried about this bank health, if there's a robust commercial paper market, and those loans tend to be cheaper anyway, so they're higher up in the pecking order. There's kind of no need to draw down on these credit lines. So it's just an additional control variable that could help you clean up the analysis.
I don't know if you want to respond.
Sure. Thank you, Kelly. Thank you, Jose Manuel, and thanks, Emil. These are all great suggestions. On the 2023, we cannot use our methodology in 2023 because it's based off binding floors. It has to be a period like 2020 when the floors actually were binding, which is what generates cross-sectional variation. That's what the source of differential exposure. So that's what creates different firms have different interest rates that they have to pay. Now, so it's anchored around 2020. Really, the longer period is there for some additional tests. So would love to do that for 2023, but this methodology is not feasible in a high interest rate environment. There were the comments that concern macro variables, like a general state of the commercial paper market, or, for example, what generally money market funds pay, also would be kind of addressed by this methodology since the variation is cross-sectional and market variables are fixed for everybody. They all can make the same on the money market funds. So in that sense, the difference matters for the gap, and the gap is preserved because it's universal for the variable against which we are benchmarking, be it commercial paper or money market funds. That's fixed. Now, I'm happy to take more questions. Maybe I'll squeeze other things I wanted to say as other people ask questions.
Please, and then first, yes.
Thank you. Jean-David Sigaud, ECB Research. Very interesting paper. As you explained, the interest rate on these lines, there is the LIBOR, which is variable, and there is a fixed part. But for how long does this fixed part remain fixed? And could it be that banks behave differently in terms of fixed parts depending on the stability of their funding structure? Meaning a bank that has an unstable funding structure with depositors that are flighty would actually make sure that they increase the spread at the time when their depositors fly out, thus creating this correlation between the two betas. Thanks.
It's an interesting idea, but this is a contract, right? So it's a contract with a fixed rate. So until maturity of the contract. So it's not clear what would be the premise under which a bank could trigger negotiation of a contract. So it's, I mean, anecdotally we know that this is a rate that one pays. Earlier, in one of the earlier discussions, presentation, I saw that there was a reference to this Blackstone case where Blackstone, and this is true for many private equity firms, that they give a mandate throughout their portfolio companies of drawing on the revolving lines, precisely because the rate on which they're going to borrow is honored. It's a rate in the contract.
Between the betas, very intriguing. And I was wondering whether you can elaborate a bit on the interpretation. I thought that one interpretation is that banks actively sort into specific depositors. So banks with more flighty depositors sort, however they do that, into customers that are where the drawdowns are less sensitive. Another interpretation would be that there's actually a negative correlation simply between drawdowns and changes in deposit volumes, because at a customer, I have two sources of liquidity. Either I use my deposits or I draw down my credit line. So if I draw down my credit line more, then for the same bank, the deposits will simply be more stable. So it might not be about the interest rate, but just about the negative correlation between drawdowns of credit lines and deposit volumes.
Let me recognize the fact that we are very focused up front on just kind of articulating the idea, making sure that the assumptions that go into the idea being true are validated, coming out with methodology to estimate elasticity, estimating elasticity. And then after we conquered all that, we put out this big thing where we say, hey, this research that Itamar and Philip and Alex have been done, let's relate this and bring this in this unifying liquidity management. And there is this interesting point that could be consistent with these interpretations that you say. I'll be honest, I didn't think about the second one where you implying that the companies have sizable deposits in the same banks with which they have relationship on revolving lines. It's an interesting idea, and it's you kind of would need to believe that when we see deposit runs, they are big chunk of them tends to be companies that are just drawing on their deposits. I think that this will go back to this point that I hope I articulated clearly, but Emil really nailed it in that what we are envisioning here in this paper is that it is a shock to a bank, right? And so if it's a shock to a bank, then you should, even if you have deposits in the same bank and revolving line, well, you should be withdrawing them both. You had them both for a reason. So that should trigger actually run them both. So the context where for some reason you're withdrawing deposits because you're concerned about something, and yet a revolving line, which funds your working capital, you're like, I don't need that. So that seems like a somewhat contradictory scenario. But agreed that there seems to be more to do in that direction.
So Tobias Berg from Goethe University, Frankfurt. Victoria, you highlight a quite positive effect of higher rates or higher differences between credit line rates and deposit rates. And I was wondering whether there's not an associated negative effect. Because the fact that firms don't draw their credit lines when rates are high means they can't implement their positive NPV projects. So isn't there a certain trade-off between financial stability that you highlighted on the one hand, but efficient capital allocation on the other hand, where we actually want firms to implement as many of the positive NPV projects as possible?
Excellent question. And I'm going to tie it back to Jose Manuel's criticism about overusing word runs on the bank. And so the key part here is that this is precautionary, right? So it's not about the whole point that we're trying to make is that this is a part where you just draw cash out of the bank and you just sit it in cash in a money market fund or in a different bank, right? So this is really not about investment opportunities. And we try to be very clear about it. This is why we picked that 2020 episode. And by the way, it was very neat to see that the same thing, the same quarter kind of pops out in Jose Manuel's graph, pops out in the opposite direction because he's plotting the opposite variable, drawn, undrawn, but it's right there, right? And the other thing that I did not mention in my presentation but becomes clear is that one thing that you could think about, oh no, that pop in drawdown was really about investments. And they just refinanced it into something else after the policy intervention, which is why the line comes down. On that front, we actually do work in the paper to make sure that this is not a bridge loan. It's not that they actually invested this and then they refinanced it, and so it comes down. We actually confirm that this is cash drawn, cash return, one period that they paid just for insurance to have that cash in their pocket. So it's not really about investment. It's run on the banks in the sense that we are after precautionary motive, which is a run on the bank.
I wonder if unless I see another hand, I maybe want to give you sort of a minute just to respond to the question of the implications for bank stability. More that this question of is this a big deal? The fact that they draw down in these periods, like does this cause instability? And if I'm misinterpreting your question, let me know. But I think, and so I wanted you to have sort of yeah.
Look, the graph, the very first graph that I showed you is a red line and deposits uninsured deposits being a substantial fraction of exposure of the banks. Revolving lines are about half of that. So that's one observation. If I think about episode like 2008, same observation. Revolving lines were not the cost of the financial crisis, but surely didn't help, right? So it's kind of one of those, so banks have runnable exposures that goes beyond deposits. And some of them are quite sizable. And revolving line probably comes in a solid number 2 and in a very large economic magnitude that we looked at. And so with that in mind, this is not really about, this is the only thing. This is one of the domino pieces in an otherwise fragile system. Or perhaps there is something to the banking, the way the banks themselves think about it, that in a way that they do their lending and then the way they fund itself, that actually offset each other at some level. So this is more a call of understanding and potentially an important exposures that could amplify, could make the effect bigger, not necessarily amplified. And something that perhaps we have to think about when we think about bank liquidity management more broadly. So it's not narrowed down only to deposits. There is more pieces, and they clearly taking that into consideration.
May I push in I fully agree with what you just said, by the way. And you know, obviously loan commitments and off-balance sheet commitments is a very important part of management of the bank, including for liquidity, and mainly for liquidity purposes, as you said. But I just wanted to ask you further a little bit of the issue of the 2023 exercise, just to make sure I understand the paper. The way I understand the paper, you use the 2020 exercise because you have the possibility that there's this kink, which I understand that, and that gives you the ability to identify the elasticity. So, but now you have the elasticity. You can do an out-of-sample exercise and try to think about, you know, in the 2023, how well does my model perform? No, at least, and see if there's patterns there that are aligned with what some of the basic assumptions in your model or not. I will encourage you to do. That's what I meant by doing that, not just estimating on the 2023.
Look, it's a good point. I think that being an academic and aiming at clearing all the big hurdles that we build on ourselves, I was focused on things that I can identify very neatly. But look, I mean, if I'm given the room to speculate, I'd be happy to do that exercise.
Please.
Hi, Rafael Repolo from Senfi. Now, in the light of the huge amount of these credit lines, as you showed in the first picture, and the potential risks for the financial system in terms of these correlated withdrawals of the credit lines, it might make sense from a financial stability purpose to reduce the willingness of banks to grant credit lines by, for example, increasing capital charges on the undrawn part of the credit lines. Do you agree with that?
Clearly not something I'm trying to think about it because it's clearly not something within this context. I'm taking these lines as something that is essential to the firm life and ability to manage working capital, and we have research for that, other papers. There is also an element of, do I see banks taking some sort of risk that have revolving lines gone up or have, so we don't see any of that, right? And revolving lines are typically senior secured, very safe. And the other point, of course, the one that relates to Kashyap, Rajan, and Stein, which is the point about fantastic papers that tells us, well, perhaps the reason why the liabilities that are heavy on deposits and assets that are heavy on revolving lines have a synergy because they both have liquidity management. And I think our paper also kind of adds an extra layer to that, and that there is more to this liquidity management that has complexity in it. I think the last graph that I showed to you actually would push back on the arguments I'm articulating. So my take, and I see that Emil wants to say something that I'm eager to hear that. My take is nothing so far indicates me that somehow we need to compress issuance or revolving lines. But you're right in that there is something remarkable about the way that they are priced. And that is that the rate on the revolving lines is pretty standard and pretty flat and insensitive to any kind of credit risk of variation. And so that perhaps is the only hint of that tints my argument.
That's exactly what I was going to say. I mean, the table I showed with all these different episodes and how the correlation basically can flip in really bad crises versus some of these more minor crises shows just like how difficult of an asset pricing problem this is to basically price these puts that these banks are writing. And that's kind of what gives you some pause there. And I don't think we actually really have a good answer for how to do that.
May I just, a very small addition, this is obviously an issue that we discuss with the banks a lot, and they argue that the capital charges may be too high, but there's another segment of the banking sector which is quite relevant, particularly which is credit cards for consumers and consumer loans, which you have essentially the same problem, in which you have undrawn credit lines with the use, and the credit rating there can fluctuate much more and much more difficult. Obviously, the margins there are completely different, the rates at which, but that's more sensitive from a risk perspective.
Quick. Oh, sorry.
Raghu Rajan, University of Chicago. This last conversation, I mean, is part of what's going on that the banks are pricing these extreme situations based on the intervention of the Fed or the central bank? That, okay, if everything comes together, then perhaps it's not so costly because we'll have a systemic issue and then there's liquidity pumped in. Or that they will access those lines which we talked about this morning, that they will access lines of credit from the central bank at that point. And so that pricing or that event is taken care of.
I think it's a great question. It might be true. As I already alluded, I think that there is a little bit, like we don't have any work that dives into thinking about variation across banks in liquidity management in the more complex ways and how much they rely on deposits, right? And it seems to me that from what we're showing you here is that there is something else there. And so that could also go in the direction of maybe the pricing of revolvers is flat within the bank, but it is not flat in the cross-section of the banks. Seems like that there is a little bit more to explore before we conclude, but it's a valid hypothesis.
So we have neither exhausted the audience nor the discussants and the speaker, but we have exhausted the time. Give me a round. Thank you. We're going to take a break now. We're just going to change the speakers.
Wonderful, and welcome back. We're going to continue on banks, and I want to introduce Juliana Begenau, who is going to present on interest rate risk and cross-section effects of microprudential regulation, flying in all the way from Stanford. Thank you.
All right, thank you so much to the organizers for putting this paper on the program. This is joint work with Vadim Elenev and Tim Landvoigt. All right, so we are motivated by the observation that banks' assets resemble fixed income securities, fixed income position, such as loans and more directly securities that decline in value whenever the interest rates go up. So banks fund those asset positions with insured and runnable uninsured deposits. And we've noticed, and this conference is no stranger to this fact, that recent rate hikes have revealed some exposure to, differential exposure to both interest rate risk and run risk in the cross-section of banks. So what we want to do in this paper is to put out a framework that can talk and speak to the differential choices that different banks take in terms of their portfolio and funding risk choices. And we do that in order to then be able to study the effects of microprudential regulation with the goal to improve financial stability on the cross-section of banks. So this paper in a nutshell, it is a theoretical model that we then take to the data. We are focusing on the cross-section, so we start with a 2-period, and that revealed a lot of complexity already, so we stop there. Typically write down time series or panel dimensions. So we do this, so we write down this 2-period model to analyze the funding and portfolio choices of the cross-section of banks. The key ingredients are heterogeneity in banks' lending and deposit productivity, as well as product differentiation in the insured and uninsured deposit market. And then banks make a portfolio choice between loans and bonds, and then the funding choice between uninsured and insured deposits. That exposes them to endogenous runs, and they can then default. We take this model to the data, calibrate it to US bank core report data, and then that rationalize the cross-sectional of banks' portfolio and funding choices, and reveals 2 different causes of defaults, solvency and run defaults, that expresses itself differentially in the cross-section. And then we study cross-sectional effects of microprudential policies and find that the size-dependent capital requirement in this framework is the most effective at reducing run risk without causing too many side effects. Now, we're standing on the shoulder of giants. Many in this room have contributed to many of the papers that we are building on. So what we are doing here is synthesizing and quantifying many of the forces that the prior literature has put forward. We're putting that together so that we can rationalize banks' funding risk, portfolio risk, and run exposure choices jointly in the cross-section. So that's the key goal. So 2 graphs of data. So to motivate, this is what we are basically trying to capture in the model. The first graph is the security share in the cross-section of banks that is decreasing in the size of banks. So on the x-axis is banks sorted by size from small to large. And on the y-axis, we take the basically liquid asset share of banks, so cash, Fed funds sold plus securities over asset. And it's declining with firm bank size, but it has a slight upward ticket towards the end. So very large banks, they hold more securities. Now, quite the opposite is then of that is the uninsured deposit share. It's increasing in bank size. So larger banks have a larger share of their deposit base that comes from uninsured deposits. So we are putting, this is the goal of the paper, is trying to rationalize these causes, these empirical effects in a 2-period model. Now, in this 2-period model, there's a representative agent, a household, that gets some endowment, and they have preferences over consumption in the first period and liquidity in the first period, as well as consumption in the second period. There's a continuum of banks that provides the consumption good and the liquidity, and they are effectively, again, owned by the household. The government insures the insured deposits, not the uninsured, and that's paid by lump sum taxes that the household has to come up from. Now, this is a two equation that are complicated. As I said, the household likes liquidity. How are we gonna do that? I want to be a bit more transparent. So they like this liquidity term H, which is basically a CES, or is an aggregator of both insured and uninsured deposits that are produced by different banks that are indexed by I. And there's a lot of terms here, but what I want to take you away is that the key parameter here that I want to focus on is this differential degree of product differentiation between the insured and uninsured markets, so this rho I. So if there is more product differentiation in a given market, and all banks have the same degree of product differentiation, but it differs by deposit type, if there's more, banks can charge a lower interest rate relative to kind of a market rate. So the household just allocates their endowment to bank equity, insured deposits, uninsured deposits, earns the profits, pays the taxes in a zero period zero. Now to the banks, two important choices, portfolio and funding choice. The portfolio choice, in the first period, the banks can buy bonds at a price of 1 that have a risky payoff, RB, that is stochastic, so this is where interest rate risk comes in, and capital at the price of 1 that has also a risky payoff, in the first period, but is subject to decreasing returns to scale. And the reason why we have that is because we want to capture in the model a size distribution. And so we need this technicality of this decreasing returns to scale to do that. Now there's the stochastic, the risk, what is coming here from is like there's 3 productivity components. Starting with this variable Z, which is actually not a risk, it's kind of a productivity type. A high Z is drawn ex ante from a distribution, but a high Z means I'm a very productive bank, a low Z means I'm not a very productive bank, and the banks know this ex ante before they take decision. RK is an aggregate shock, and epsilon, the role is an idiosyncratic shock whose role I will explain in a few slides. Now funding choices, they issue insured and uninsured deposits at some discount price, bond prices, similar to that. And the importance is that the uninsured deposits, and banks know that they're subject to this run risk, and banks take that into account. After runs, there's a default option with bankruptcy costs. So what our model can capture is basically different degrees of balance sheet differentiation across the size distribution, such that, for instance, small banks have a higher bond share, like in the data, versus large banks have again a higher bond share compared to the medium-sized banks, and are more funded with uninsured deposits relative to insured deposits. I want to solve the model backwards, and I hope I can do this in 2 minutes. There's just 2 periods, and the last period has 2 stages. The first stage, if there's a run, and then the second stage is the equity payout and default decision. So if there's a run, and these running depositors at the right-hand side of this equation take out their funds want to take out their deposits from the bank has to look at its assets. We have loans, we have securities. Which of these I'm going to liquidate to pay out the banks? So we assume that the loans are illiquid. If a liquidity problem, or like with a fire sale discount, if this is large enough, the bank would prefer the bonds to redeem the depositors, and that gives also a precautionary role of holding bonds on the balance sheet of banks. Now, depending on whether a run has occurred or not occurred, the equity payouts is different in the second period, because what I'm getting in the last period, what can I pay to the dividend to the shareholder, is basically whatever my loan produced in revenue, whatever my securities produced in revenue, and then I repay my depositors from that, whether or not they have stayed around, so if there's no run, or some of them have run, and then just I have to pay out the remaining depositors. Now, I want to now clarify what is this role of these epsilon. These little epsilon, they define the default threshold that we then can tractably capture default in this model. This is going to be still dependent on the choices of banks, but depending on this default threshold, we can kind of characterize when runs occur and when default occurs. So if this epsilon shock, this productivity shock is low enough, the bank is going to get insolvent. This is on this line here depicted. And we assume the bank is going to be shipped immediately to the FDIC or the receivership and no run occurs. If the epsilon is large enough, then the bank would survive a run, so no run occurs, also no default occurs. This is called the run-prone region. And then run, so therefore, can only happen in the run-prone region in this intermediate stages of this idiosyncratic shock, that then the run is only occurring with a sunspot realization with some random drawn probability. However, the size of that region is an endogenous decision by the bank. They can choose not to have any uninsured deposits, and then this region collapses and has no mass. Now, what's the bank's problem in the first period? So going back, they know all that. They choose. They expect them maximize dividends by choosing loans, bonds, all their deposit funding structures, conditional on survival, subject to the budget and regulatory constraint. Budget constraint, they have to purchase these loans and the bonds, and those have to be funded with equity and deposits. Banks internalize really the effect of their choices on the demand for deposits. There's this monopoly pricing in there, but also the pricing of their default risk for the uninsured deposits. Now, there's lots of, and I know that my discussion is going to go more under the hood of the model. There's a ton of parameters, but I want to focus on the key parameters here when I talk about the calibration. The parameters that I alluded to, this degree of product differentiation in the insured and in the uninsured deposit market. And we calibrate them to the Gini coefficients of uninsured. That gives us the high concentration of uninsured deposits in the largest banks, and the differentiation deposit rate. And that results in that there's more product differentiation in the insured market compared to the uninsured market. And that's important for the results in the model. So let me get to this. So the first graph I want to show you, this is the last data slide that you're going to see mixed with model results, is that on the top here we have the model, on the bottom is, on the top we have the data, on the bottom is the model. The left column depicts the assets, the middle column the bond share, the right column the uninsured share. And you can see that the model captures the characteristics of the size of the cross-sectional distribution in these quantities pretty well. Why does it do that? So this is what we're feeding into the model, the loan productivity distribution, the CI. That if you're a more productive bank in our model, you choose a larger asset size. That's not surprising. So, but you also choose a higher uninsured share. Why is that? In particular, the small banks, they choose no uninsured share or a very low one. And the reason is really this, the product differentiation. For the small banks, their size, the optimal size is mainly driven by the deposit business, whereas for the large banks, it's a combination between deposit and the lending business. The small banks are basically just good at deposits, and you can make more money in the insured deposit market. That's why they exhaust their balance sheets size already with insured deposit. They can more than enough fund that. Whereas the large banks, they have a larger balance sheet size because of a profitable lending business. They don't want to go all in insured deposits because that would exhaust the margins they could charge on that. And therefore, they also fund themselves with uninsured deposits. The flip side of that is when the small banks have no profitable lending business to go in, how do they back their profitable deposit, the insured deposit business? Well, they fund that with bonds. And this is what we see. The small banks hold bonds to back the insured deposit business, whereas the larger banks, they don't hold bonds up to the very large because they hold, again, a sizable amount of uninsured deposit, and they face, that's the right graph, higher run probability, and they hold then these uninsured, the bonds as a precautionary reason to hedge against run risk. Now, what happens if there's an interest rate shock in the model? So the model captures normal changes in interest rates. So when what is interest rate risk? For instance, a rate increase that lowers the realization of the return on the bond portfolio of the banks. That leads to solvency defaults in the small banks. We can see that in the left panel, in particular when the loan return was also bad. It leads only to run defaults, elevated run risk for the largest banks. And so we have these two causes of default, and then together they lead, then the right panel is just the combination of either solvency risk or run default. Now, what happens if there's an unanticipated rate hike event? So it's an extra low in the model, that's an extra low bond return realization. That unexpected rate hike nearly doubles the risk of runs for these largest banks in this model. Now, given these characteristics, what can we do? So in the last 5 minutes, I want to walk you through some policy counterfactual. Relative to the model that I've showed you, we've also now introduced for the largest banks a too big to fail guarantee. So that you know, because we thought that this was important, given that this is we think that this is a plausible environmental feature. Now, what happens if you tightened basically a capital requirement of the bank? That is the theta. Tightening means that we move it from 88% of assets against which you can borrow, you reduce basically the theta. That means tightening. That's highly effective at curbing the run risk of the 0.1% of banks. So it nearly eradicates all run risk. However, there's a standard trade-off that people familiar with this type of models would realize. While deadweight losses or excessive bankruptcy costs are curtailed in this type of models, we also reduce liquidity in this model substantially, which the households doesn't like. So now what's more is a targeted policy, which regulators already are pursuing, is introducing a size-dependent capital requirement. You can see the size-dependent capital requirement relative to what I've showed you prior on the bottom left graph. So this is how we tighten. The green line is where it's go. This is tightening the capital requirement for the largest banks. Now, this leaves the uninsured share stable, and it's very effective at curbing the run risk of the largest banks because they are forced now to basically delever, and you can see that in the bottom, middle bottom panel. This is more targeted than the capital requirement across the board. Now, the second different policy that we've tested here is a liquidity requirement. So now we vary the amount of bonds you have to hold if you issue uninsured deposits. So this tighter liquidity requirement is also effective at reducing the run risk of the largest banks. You can see that here also in this green line. But when you see this, the green line compared to the blue line, the baseline, or a capital requirement, which is the red line here, it leads to massive changes in the bond share across the size distribution. So there is somewhat unintended consequences while we are trying to target the uninsured share of the largest banks and forcing them to hold more bonds. We are also forcing more bonds onto the mid-sized banks, which started to have some uninsured deposits that are actually quite good at lending, but they have to hold then bonds in order to fulfill this liquidity requirement, which, this is the comparison of the model, leads to more dispersion in the productivity of loan allocation, let's say, of the productivity of capital. So it leads to misallocation of loans. This is what this red, the SD standard deviation of the marginal productivity of capital in the right column here indicated as red shows. It reduces run risk, but it comes at the cost. Whereas the capital requirement I already alluded to is really effective in reducing the run risk for the largest banks, but also has some lending, less lending and fewer deposits. Now, in the middle is the size-dependent capital requirement, which is way more targeted, and in this model leads to a substantial reduction in the run default probability without changing the allocation, the optimal portfolio allocation across the size distribution. Now, let me conclude in the last minute. So we, in this paper, we show model ingredients that are needed to match the cross-sectional heterogeneity in bank assets and liability positions. And what's really important and want to re-emphasize is the heterogeneous asset productivity, which is in deposit productivity and deposit product differentiation features that the IO literature has already emphasized. Really important to capture that. Then we find different manifestations of interest rate risk in the cross-section. For small banks, it's really solvency risk. For large banks, it has run risk consequences. And we do that then to study the financial stability consequences of microprudential regulation in the cross-section of banks and find that the size-dependent capital requirement reduces runs at the fewest side effects. Okay, thank you. Looking forward to my discussants.
And the first discussant is Agustin Landier from HEC. It's all yours.
Thanks to the organizers. Okay, so I will do two things. So first, try to give you the main intuitions of the model, and then some comments on the policy message of the paper. So just to place a bit the paper, so it's part of the post-Silicon Valley Bank regulatory debate. We know there is this potentially toxic mix of uninsured deposits and interest rate sensitive assets. And so there is a debate on, should regulation think twice about this issue? And so the paper's angle is to have a structural approach and build a model that jointly endogenizes the distribution of bank size, the funding mix that banks choose, namely, the level of leverage and the allocation between insured and uninsured deposits, and the asset mix that they choose between, investing in loans versus securities. And then the paper tries to use this framework as a policy lab to see, what kind of policies might improve welfare. Okay, so the goal of, the challenge in a sense that the paper is raising is to try to match three stylized facts at once, namely the distribution of bank size, which is very skewed, the security share that banks invest in. So these are graphs that Julian already shown. I'm not going to discuss them too much, but basically there is this decreasing and somewhat U-shaped at the end distribution of the security share in banks' assets by size. And then the third stylized fact, it's the third graph, which is the fact that large banks rely on uninsured deposits much more than small banks. Okay, so the idea is to try to match these three facts. Okay, so let me give a very brief sketch of the model. It's a big challenge to give justice to the model in so little time, but let me focus on a few pieces. It's a big machine. I will focus on a few pieces. So the first one is, okay, what do banks do? So first, banks are different in their level of productivity. Okay, and this productivity matters for their ability to raise deposits, but also their ability to lend. And that's the same. Basically, there is a one-to-one correlation between the two things, being productive on the lending side and being productive in raising assets. Okay. So then, once they have chosen their liabilities, namely how much deposits they choose to raise and how much insured versus uninsured deposits they raise, they decide, how to invest them between loans and bonds. They know their productivity, so they know whether they are good at lending, basically. So then shocks arise. Okay, these shocks can be aggregate and idiosyncratic. And there are two types of issues that can happen. So the first one is a sunspot run on uninsured deposits. It can happen if there is some vulnerability to the bank, namely that, it could be that it's not able to fully pay its deposits if you don't run with others. So if runs happen, what the bank does is it has to sell its liquid securities, and it follows a pecking order, right? So first selling securities and then loans. But if it sells its loans, it does so at a fire sale price, so there is a pure waste cost to do that. Okay, and so if they are insolvent, at that point, banks default. They can also directly default if the shock they face is so big that actually a run does not even have time to happen. Okay, so the second big player is households. Let me spend just 1 minute on that. But the originality of the model is to try to basically have a representative household which has some preferences for insured versus uninsured deposits at each bank. And there is this big liquidity utility aggregator, which is going to be asked to match the data, basically. Okay, but so in this representative household, it's going to put a little bit of deposits everywhere, and it's going to be putting more deposits in banks that are productive at raising deposits, okay? Meaning that these deposits must be of high quality, in a sense the service they provide must be of high quality. But it's important to understand that here we have a representative household which is investing basically in all banks in the economy, a little bit of its wealth, and more so in banks that are highly productive. And households also have this sort of preference for having a mix of uninsured versus insured deposits, and this mix, which will be determined by alpha, is going to be matched to the data. Okay, so now there is a third player, which is the regulator, in a sense, which is going to try to basically maximize welfare in this economy, and it has two main tools in the baseline, namely a leverage constraint, so that's the parameter theta in the first equation, and a liquidity coverage ratio, namely it can say, look, if you use like deposits, you need to keep some liquid bonds in front of them. And so ask yourself, what are the sources of inefficiency in this economy? So there is a classic insurance externality, namely banks try to take advantage of the insurance on deposits. But it's not, let's dig a bit further, because there is a lump sum tax, so it's not distortive per se. What is distortive is that when default or fire sales are strong, they force banks to liquidate at a fire sale cost, which is assumed to be pure waste. So that's really what basically is the source of inefficiency. It's these fire sales that are basically forcing banks to liquidate their assets. The second source of inefficiencies is the fact that deposits might be misallocated. So there is a first best allocation of deposits that responds to these preferences of households. And if you regulate in a manner that, let's say, for example, is too favorable to large banks, you might destroy the ability of the households to dispatch their deposits efficiently towards smaller banks. Okay. And then there is an equilibrium. So let me accelerate a bit. So I will have, let me skip the policies. Let me directly go to my main comments. Well, I think the first one is, I don't think you want the paper to be that dependent on this idea that this curve is U-shaped, because it really relies on a few data points. I pulled out data from Europe, where also you don't have any symptom of a terminal U-shape pattern at the end. So in a sense, the model it's independent on that, but I think you don't want to emphasize it too much, this U-shape idea. So then three main comments. So the first one is, it's about welfare. So it's interesting, the structural approach and the way you match it to the data using these household preferences. Basically, the way it interprets this distribution of deposits that you see here, it comes from the paper. So you have assets on the horizontal axis and the rates on deposits on the vertical axis. And so small banks pay very small rates. And that's going to be mechanically interpreted by the model as the fact that small banks are very productive at producing deposits. So meaning that they must be providing really high quality services. And so here my point is really, do we really believe this? Or an alternative explanation is that they could just be exploiting unsophisticated customers, elderly people, or just local monopolies that remain there. But the welfare interpretation is a bit dangerous, right? To rely too much on this idea that it's very important to preserve the deposit franchise of the small banks. It's an open question in a sense, but the paper takes a strong stance on that by interpreting these small rates as an indication that there is a high service provided there, high quality service provided there. The second one, it's a bit of a cheap shot, but the paper, obviously, it's already a big machine, so it leaves aside a big chunk of the economy, namely production, the fact that companies need to borrow, and so in a sense, all the inefficiencies leave aside, right, a big part of what we traditionally think as the main inefficiencies that are involved with bank vulnerability and crisis episodes. So it's something I think to at least discuss in the paper, how much we should think when you tackle welfare analysis and optimal policy tools, that's something to definitely tackle. A small thing also is the loan fire sales, which are the biggest source of inefficiencies, apart from the misallocation. They are supposed to be pure waste, but someone is buying those loans. So ultimately, I mean, in the calibration, yeah, how much is wasted? It's a bit open. Let me finish with one point, and it's not about this paper. It's a bit more broad. So I think, in a sense, it's striking when we look at the banking data, how much small banks are going to play a big role in any kind of calibration exercise. And so it's a bit like the entrepreneurship literature, where we try to keep to as much as possible the idea that mom and pop shops are the same object economically as unicorns, but there are limits to that. And so sometimes I feel, maybe it would benefit from zooming on, the part of the distribution that is really important. And as you mentioned, it's extremely skewed, right? So this is the cumulative distribution of assets, and you see it's extremely skewed. So in a sense, it looks like, like getting rid of the top 60% of all your graphs, in a sense, will not, will enable the paper to zoom on what is really like driving the economy. But, it's an exciting paper. It's quite original, delivers compelling economic insights. It's a big machine, so to make it work, you need to leave aside some aspects. But definitely made me think about many issues, and it's courageous in a sense to really try to be structural on this topic. So thanks a lot, and I leave the floor to Marcus.
The next discussant is Marcus Brunemeyer from Princeton.
Thanks a lot. It's a pleasure to be here, and thanks for the organizers and everybody here, and for discussing this nice paper. So I would like to start with putting this paper a little bit step back, what the paper does relative to what the many other papers do, including Giuliani's earlier papers. I would say, this paper has, of course, productive firms and households and the banking sector. But most of these papers focus on one banking sector and a time series focus. And while this paper really looks at the cross-section, so it looks across various banks. So the time series focus was very much in mind amplification, fire sales, and deflation, and spirals, and on all these things. And of course, fire sales occur in this paper as well. But it's all about, you might, through regulation, lower the amplification, but it might also delay the bounce back. There's a resilience trade-off and other things going on. And Giuliani and others have done a lot of work there. In this paper, it's all about, or it's primarily, let's say, about the cross-section. How does it play out across various banks? And I think that's a big contribution of this paper, and there's very little in that space compared to the time series space. So, and it's a big paper. There's a lot of things going on. So what I will do is I will walk through the paper and then say, okay, what about this thing? If we change it this way, I come with a lot of questions, essentially. What will happen if you change that? And I won't have all the answers, or very few answers. It's up to Giuliani to provide them later on, well, today. So essentially, the paper, the model is a two-period model. It says the focus is on heterogeneous banks. The banks, they have some loans with a return of RK and some other components. They can hold some bonds with interest rate risk. And there's also a risk-free asset. There's no portfolio choice between the bonds and the risk-free asset. That's actually, this omega is tied down, I think. So that's my first question. Why do you tie it down? Why don't you rely on a portfolio choice across all three of these assets? And then the banking sector can issue some insured deposits, some uninsured deposits, and then there's the bank equity. So that's going on the bank side. And then there's, of course, a repressive household, and that's already what Augustin indicated. There's liquidity in a utility function. So this psi parameter is actually pointing, so how important is this component? Otherwise, it's a simple Epstein-Sin utility function with IES of 1 and risk aversion of phi. And then in the liquidity itself has a CES aggregator in it with different weights on the insured deposits and uninsured deposits. And some banks are better than others, and that's the capital A is reflecting that. And it's a CES with some elasticity of substitution of eta divided by rho I. That's also, again, insured versus uninsured. So there are two components always playing in this. So this can be seen, I think, as a CES aggregator, but I think if you were to microfound it, because we don't have a continuum of banks, each of us, you probably want to have a discrete choice model, but this would translate in the same CES liquidity aggregator. So that's, in the big picture, one big component of what's going on. So in terms of the challenge for the paper is that to set up this whole model, and I won't go through the whole model and then bring it to the data and calibrate the model. There's a lot of parameters, and there will be more parameters I will just mention. So the main results in terms of calibration is that there's a huge concentration in the size, in the banking size. And that's driven by this decreasing returns to scale in this loan technology. Some banks are more productive than others in granting loans. The large banks hold loans and issue uninsured deposits. So the runs occur in the large banks. And then there's the largest banks, they hold more bonds than the large banks. So that's a special for the largest banks. And then there are small banks that hold bonds and issue insured deposits, and they focus on essentially on the deposit business. And then there's some comparative static. So what happens when we make these bonds, these long-term bonds, more risky, more volatile, or we increase just the downside risk. Okay, so Juliani, I didn't have time to go into that. But the question is, once I allow some portfolio choice between the risk-free short-term reserves, let's say, and a long-term bond, how does this change? That's one question. I can't answer it because it's too complicated to do on the spot. So the model in general has a lot of degrees of freedom. And in terms of calibration, there's also a question a little bit. It's a two-period model. And when you calibrate it, for banks, the franchise value is a very important component, whether you default strategically or not, or what situation you go into. How does the calibration depend? It's different from a two-period model, from an infinite horizon model, let's say, and then you have a much potentially bigger franchise value. And also depends, of course, on the discount rate as well. So if you change policy, the franchise value is changing as well. So how would this affect the calibration is another question, which would be interesting to answer. Now, what the paper is not, and that was initially I thought, the leading example would be Silicon Valley Bank, First Republic, or Signature Bank, but it's actually not about that. It's about that in terms of that the interest rate risk on the long-term bond is really the driving force, is a big driving force. But it's not because in the model it's primarily the big banks, and these were the regional banks driving that. But I think what would be nice in the model, of course, there's a lot of things going on, but what we saw is that people run from these banks into the big to fail banks like JP Morgan. Okay, so there's the analysis on runs is very nice. It's always running out. I guess you run into cash, but what you really do in the real world, you run into some big to fail banks. And perhaps the analysis, there's a too big to fail chapter in this, but it doesn't have this run to some big to fail bank. And it would be nice to extend it to this way. Yeah, so that's essentially one extension one could do. So let me go a little bit deeper with some little notation here. So how's the risk modeled? So there's aggregate risk, there's idiosyncratic risk, fundamentally idiosyncratic and aggregate risk, and then there's run risk as well. So the aggregate risk is this RK, so K is the capital or the loans you grant, that's the aggregate component to it. And then the bank has this epsilon idiosyncratic risk, epsilon I. And then there's also some run risk, which depends on the sunspot realization, which is this var sigma. And then it also, of course, depends on the fundamentals of the fundamentals RK and RB. The RB is the return on the long-term bond. And the assumption here is that if you look at the total loan risk, it takes on, does this work? Yes, it takes the whole elements here. So it is some, I think it's now in the new version, it's called Z or Z, epsilon. And so on. If you're a better bank, you're more productive, and that's translated ideally translated in the model as a larger A. Okay, so you have higher returns. But if you look at the specification, it's also the case. If you have a larger A, you also have a larger risk. Okay, So you would say, okay, is it the case that more productive banks have also worse risk management? Okay, so that's, you might, because one argumentation would be that if you are a very good bank, you might also be very good in risk management. You might not be better in identifying better projects with high expected return, but you might be better to handling the risk. So if you were to change this specification, would the conclusions change radically or not? Which I don't know, but it would be interesting to figure out. The other assumption is that the return on the loan book, this RK, is independent of the return on the government bond or the long-term safe asset with interest rate risk. But you know, if you think about it, if there's an aggregate shock on the loan book, typically as flight to safety, and you know, then actually there's a negative correlation there. Perhaps one could include some negative correlations on flight to safety component on this as well. Now, the next thing I would like to say is that, of course, what the authors would like to do is they would like to have a nice size distribution across the banking sector. And what you do is you do decreasing returns to scale. But you know, in the banking literature, it's not always clear that you want decreasing returns to scale. You might want to have also some increasing returns to scale. Economies of scale, essentially, in the banking literature. But there's a lot of fixed cost, you know, IT costs and all this. And diversification improvements happen as you grow the business. So I guess the justification is you first some increasing returns to scale. At some point, it will become decreasing. And I don't know whether that's easy to generalize and just include that. And then there's, of course, an economies of scope. Here, it's assumed that if you're very good in loan provision, you're also good in providing deposits, issuing deposits. There's some king function. I don't have the time to go into that. One could change that. The other thing is, which I think is a big issue I would like to address, is like the fire sale discount. So there's an exogenous fire sale discount, just about a fraction of delta. But if you think about it, you know, you have a fire sale, you have a liquidity run. If you're in this range, this epsilon range, depending what positions you took, the solvency run, and that affects then the cross section of the banks, and the cross section of the banks affects again the fire sale discount. And so endogenizing this or making an equilibrium story out of it rather than exogenous would be nice. You can even have some deflationary pressure coming from the liability side, as you know, have deflation when there's a demand shock in the economy. Let me conclude, given that I underestimated the time. I think it's a first-rate finance paper. It's a very nice paper. It has a lot of things going on. It's a two-period model, but there's still a lot of things in it. It's not necessarily about the Silicon Valley Bank and First Republic Bank and Signature Bank. There's some modeling choices which I went through. It would be nice to extend it in various ways. And it has some very nice policy implications for micropotential cross-sectional implications for regulation. Thanks.
So thank you. We'll follow the same procedure. And please remember to introduce yourself. I'll start with David. I'll go after you next, please. And then wait for, I think it's coming around. Please, yes, the microphone.
David Sharfstein from Harvard. So the paper and a lot of the literature kind of assumes that what banks are trying to do is maximize the present value of their equity. But if you look at the way banks are managed and how they think about interest rate exposure, they're very focused on volatility of income. And you can see this because when they report in their annual reports what their exposure is, a little bit less on the economic value of equity, and the things go in the opposite direction. An increase in interest rates generally helps you on the income side because your loans reprice faster than your liabilities, and hurts you from the economic value of equity perspective. And those two things are at odds with each other. But my sense is that the income exposure is much more prominent in the way banks are managing interest rate risk. And in particular, if you look at their interest rate swaps and what they're doing on the risk management perspective, they're swapping into receiving fixed rate, not receiving floating. And in some sense, you can also view the holdings of these treasuries and mortgage-backed securities as itself not in exposure to interest rate risk on the income side, right? In other words, it's hedging out the fluctuations in income. And I just wonder whether, I mean, it's hard to go to that, I guess what I'm suggesting is instead of having a 2-period model, you want to have a 1-period model and think about what the policy implications are in a world in which banks are thinking about it from a kind of ROE income perspective rather than the longer-term economic value of equity perspective.
For David for this great. You know, I'm very sympathetic to the idea that they are trying to maximize ROE, and I know very well that they think about interest rate risk in terms of income, not at all about value. As I have actually work that shows that banks use derivatives to increase interest rate exposure rather than decrease it on the balance sheet. So I'm aware of that. It is actually, it's very, you're right, actually, this would call for a different paradigm on writing down models and would deviate from standard ways to write it down almost radically, which we should do. I agree with that. We should do this because it's actually closer to where banks are. So let me also, I don't know if I'm going to get the opportunity to thank my discussants. I thank you so much for struggling through the equations and making sense of them in a thoughtful way. And I want to give other people also a chance to, I will use my opportunity later on also to respond to some of the comments.
Please.
Christian Kubica, ECB Research. Thanks for the great paper. I have a question on the omega that Marcus has highlighted and the role of bonds in your model, because it seems to me that banks choose to invest in bonds for liquidity reasons, but that has the side effect of exposing them to interest rate risk. And so I'm wondering whether if you disentangle both, banks would still choose to be exposed to interest rate risk on their asset side on top of the loans that they originate. So I think that is more or less the same question as what happens if you endogenize the omega. And then relatedly, the presumably U-shaped distribution of bond holdings, I'm wondering whether it is simply an artifact of large banks being also dealers in the bond market and therefore holding a lot of bonds, the very, very, very large banks.
Okay, so let me answer your first question first, which is also related to Marcus' comment. So we are actually working on a new version of the model that I didn't have. It takes time to calibrate it, so I'm not exactly sure about all the results, but we have extended the portfolio choice to reserves and bonds and the loans. So reserves are in the model the risk-free asset that banks can hold, and the idea was, well, would this undo? And the results that I'm looking at in my head, it goes through. So, but it would still be the case. So the reason why is because there is kind of this reach for yields. The reserves pay lower interest rates than what the bonds do. So they prefer to deal with a liquidity risk in some sense with the largest banks I'm talking about with bonds. So the smaller banks, they hold bonds for very different reasons than the large banks. So different motivation. They don't have good investment opportunities in the lending or other market. So that's why they invest in securities to, which then is coming back to David's point, that kind of hedges also the income. But it's in our model a side effect, which is consistent with the data, not as a result from keeping wall flat as opposed. So, but you don't have that in the model that banks would hold, large banks would hold bonds purely because they are market maker. All that is kind of packaged in what we call loans. Thank you.
Please, fill up and then we'll come back.
Thank you. Philip Schnabel from NYU Stern. It's sort of following up on what David said. So my understanding, from talking to banks when they think about interest rate hedging, is, you kind of look, what do you have on the asset side, what's the repricing, you try to match that what you have on the deposit side. And so, if you do that successfully, which it looks like it do in, at least in aggregate, is you end up with a stable NIM and a stable ROA. And so that means also when you have sort of like positive duration on the asset side, you look at the deposit side, you have negative duration there as well. And so, I know it's a big machine, and you both emphasize the importance of the deposit franchise as well. But at least in our work, it looks like, the fact that the deposit franchise has negative duration is like really a first-order consideration when thinking about interest rate risk management. And that is a reason why they hold some of these long-term assets. And it seems that's missing in the current version of the model.
So, thank you for the question. It's a great question. I would actually think that for the small banks, we would get that because we are focusing on the portfolio choice problem. So we don't look directly at the cash flows, but it would be the case that basically the negative duration of the deposits coming from the insured deposit franchise, let's say that the small banks have, would be perfectly matched by, well, I don't know if perfectly, but they do go into security. So I think that's kind of consistent with your work. We do not have a deposit franchise in the model. I think, to be honest, it wouldn't be. So actually, we tried and we found that it just unclear how to calibrate its content and unclear how it would behave in a two-period model. So I think we want to go for that in a dynamic model, which was actually our original goal, but we got stuck in the two-period model. And then I think we cannot give it justice to do that. So we kind of left this off the table for other people to work on this topic. Yeah, that's a good question.
Emil Werner, MIT. So very nice paper, really enjoyed it. If you look at the banks that were subject to runs, for example, in March 2023, one thing that's interesting from the perspective, for example, of liquidity regulation is that actually the way that they managed the runs was not so much by selling securities, but by borrowing, first from the FHLBs, then at the discount window and the bank, the Fed's facility. So I wonder how, in your model, if you added sort of some facility that was an expensive source of funding that banks could access, where they would, if there was a run, they would lose some of the deposit franchise that they have. They might still have some on the uninsured deposits by replacing it with more expensive funding, but you're going to get a much smaller run region, and then you're going to have less of a reason to be holding securities, to protect yourself against runs. I wonder how you think about that.
That's yes. So to have another policy instrument in some sense, yes. So we could definitely do that. That is interesting. Let me also say, because Markus alluded to that, and Augustine also, that kind of we got motivated, and I got motivated by this paper because I've been long working on interest rate risk exposure and banking. But to put it in the model, that was kind of always on my list, but I didn't do it. Then SVB happened, and then of course this seemed first order. So we were in some degree motivated by SVB, but our model doesn't speak well to SVB. And we thought about many things and how we can add more and more parameters to make this odd SVB animal happen. And we were not really satisfied with that. So another way also how as other banks have in the data dealt with these runs is using reciprocal deposits. So Shohini Kunda, for example, has a paper that shows that some of the banks that were very similar to First Republic and Silicon Valley Bank, they cracked on this reciprocal deposit machine, which means they had access to insured deposit by swapping some of the uninsured against insured deposit, and that stabilized some of these banks in an effective way. They looked otherwise fairly similar to SVB in the sense that they were mid to large size banks and that had a lot of uninsured deposits. But yeah, point taken, we can happily take this.
From Senfi. In your calibrated model, are capital requirements binding? Or put it another way, if you eliminate capital requirements, would you have positive levels of capital, and how would they be distributed in the cross-section of banks?
Excellent question. So that depends on if you are a bank that is fully funded with insured deposits, they are binding. If you are a bank that is funded with both insured and uninsured deposits, they may or may not be binding. And effectively, some of the comparative statistics that we have in the model shows that for the largest bank, they can become non-binding. And that's kind of, again, also a way of hedging against run risk that they can do. Yeah, but for the small banks, they would be effectively binding in our model because they exploit the deposit insurance put from the Fed.
I think that's it. We will give Juliana and discussants a hand.
Many notes.
Oh. We're going to have a brief reception out there, and for those who've registered for dinner, that will come after the reception, the same place we have lunch, if you can find it.